It feels like everywhere you turn lately, those letters E, S, and G are just popping up constantly.
They really are.
And while it might sound like, I don't know, just another trendy acronym, especially here in the EU, it's becoming really fundamental
Absolutely fundamental, yeah.
to how businesses operate and, honestly, how we stay informed about what's really going on. This isn't just about checking a box anymore, is it?
No, definitely not. This isn't about feel-good initiatives anymore, not solely anyway. In the EU, we're seeing a real push towards concrete regulation.
Okay.
And right at the heart of this are two key frameworks: the Corporate Sustainability Reporting Directive, CSRD,
CSRD.
and the EU Taxonomy Regulation.
Okay, let's unpack this then. CSRD and the EU taxonomy. It sounds a bit like alphabet soup, honestly.
It can feel that way.
So our mission today, for you listening, is really to cut through that complexity. We're going to dive deep into what these regulations are actually about, why they matter, and what the big picture implications are. We've been looking at an expert's overview of these rules, trying to break down exactly what you need to know without getting totally bogged down in the technical jargon.
Yeah, think of this as your cheat sheet.
Exactly. Your cheat sheet to understanding what feels like a really significant shift.
It is. Think of it as your shortcut to understanding these big shifts and how companies are now expected to think about and report on their wider impact.
So we heard the names. Let's get down to it. What exactly are CSRD and the EU taxonomy in practical terms?
Okay, so the CSRD. It's essentially the new and much improved version of the older non-financial reporting directive, the NFRD.
Right, I remember NFRD. Less comprehensive, I guess.
Much less. And what's fascinating here is the sheer scale of the increase in companies that now fall under CSRD's scope.
Oh.
We're talking about around 50,000 companies, 50,000, across the EU, and even companies operating outside the EU, but with significant business within it.
Wow, 50,000. That's huge compared to NFRD.
It's a massive leap. So this isn't just some niche concern anymore. We're talking about a fundamental shift in how a vast number of companies, both inside and outside the EU, are now obligated to be transparent.
Transparent about their broader impact.
It's a real potential game changer for corporate accountability.
So what are the key differences then? What kind of information do these 50,000 companies now have to provide?
Well, under CSRD, they have to disclose a much broader range of information. This includes their environmental, social, and governance impacts, the E, S, and G,
Okay.
but also any financial risks they face that are related to ESG factors and details about their own governance practices.
So it's not just here's our environmental impact. It's also here's how environmental issues might impact us financially, and here's how we're run.
Precisely, that two-way street. And a crucial element, really crucial, is the introduction of mandatory assurance.
Assurance, meaning?
Meaning the sustainability information they report will need to be checked and verified by an independent third party, much like their financial statements are audited. Oh, okay, so adding a layer of credibility.
Exactly. And to make all this information comparable across those thousands of companies, the CSRD mandates the use of European Sustainability Reporting Standards, or ESRS.
ESRS. Okay, another acronym.
Yes. But think of them as the sort of generally accepted accounting principles, the GAP, but for sustainability. Standard rules.
Got it. Standardized reporting makes a lot of sense if you want actual comparison. And who specifically gets caught by this new directive first?
Initially, it's the large EU companies. But eventually, EU-listed small and medium-sized enterprises, SMEs, they'll also be included.
Okay, so it phases in.
Yes. And importantly, non-EU companies, if they have a significant presence in the EU, think subsidiaries or branches generating substantial revenue here, they will also need to comply.
Right, so it reaches beyond the EU's borders in that sense. It's okay, that covers CSRD basics. Now, what about this EU taxonomy? How does that fit in?
The EU taxonomy is, well, it's a different but definitely related beast. Think of it as a science-based classification system.
Classification for what? Its purpose is to define which specific economic activities can actually be considered environmentally sustainable. It's like a dictionary or a checklist.
So it defines green.
In essence, yes, for environmental aspects. So far, the focus has mainly been on climate change mitigation and climate change adaptation. Those are the first two environmental objectives it tackled.
So it's like a rule book for what activities count as green, and does that then feed into the CSRD reporting?
Yes, exactly. Companies that fall under CSRD will also have to report on how their activities align with this taxonomy.
How specifically?
Specifically, they need to disclose what percentage of their key financial metrics, their revenue, their capital expenditures, CapEx, and their operating expenditures, OpEx, are associated with activities that meet the taxonomy criteria.
That sounds like it could get pretty granular digging into specific business lines and investments.
It absolutely does. And the taxonomy itself operates on 3 core principles for an activity to qualify.
Okay, what are they?
First, the activity must make a substantial contribution to at least one of the 6 defined environmental objectives.
Like climate mitigation, you mentioned.
Right. Second, it must do no significant harm, often called DNSH,
DNSH.
to any of the other 5 environmental objectives.
So you can't boost one thing while wrecking another.
Precisely. And third, the company carrying out the activity must comply with minimum social safeguards. These cover fundamental areas like human rights, labor standards, based on international norms.
Okay, so it's not enough just to be good for the climate, for example. You can't be causing significant harm elsewhere, environmentally or socially. It's aiming for a holistic view.
That's the idea.
And all of this, the CSRD reporting, the taxonomy alignment percentages, it's all subject to that external verification, that assurance you mentioned.
Correct. These frameworks are designed to work together. They create a system where sustainability reporting becomes standardized, what counts as green is clearly defined based on science, and importantly, it's all verified by external auditors. Building trust.
Okay, so we have the what's. It's a big step up in transparency and definition. But understanding why they're generating so much buzz and maybe some anxiety and are considered complex. That seems key. Why are these regulations seen as so complex, and why are they still, evolving?
Well, for starters, you have to remember these are relatively new frameworks. The ESRS, those actual reporting standards for CSRD, they were only finalized in mid-2023.
Just last year, basically.
Exactly. And we're still expecting sector-specific standards to continue rolling out, probably from 2026 onwards.
Okay.
So the detailed rules for certain industries aren't even fully baked yet.
Right, so the rule book is still being written in some areas, which naturally adds complexity for companies trying to prepare.
Precisely. And then there's the EU taxonomy. As I mentioned, it currently only covers 2 of the 6 environmental objectives in detail: climate change mitigation and adaptation.
Only 2 out of 6. So there's more to come there, too.
Oh, absolutely. We fully expect its scope to broaden over time to properly define substantial contribution and do no significant harm for the other 4 objectives.
Which are?
The sustainable use and protection of water and marine resources, the transition to a circular economy, pollution prevention and control, and the protection and restoration of biodiversity and ecosystems.
Wow, okay, so big areas still to be fully defined within the taxonomy.
Big, complex areas. It makes sense, right? The EU Green Deal is this huge, overarching ambition. These regulations are tools to help achieve it, so they'll likely need to adapt and expand as the whole Green Deal strategy progresses.
Yeah, that tracks. It's not a one-and-done piece of legislation.
Definitely not. We should anticipate continued revisions and updates coming through EFRAG. That's the European Financial Reporting Advisory Group. They advise the Commission on standards.
Okay.
And updates coming directly from the EU Green Deal roadmap itself. It's a moving target to some extent.
And you mentioned something earlier, double materiality. That sounds intense.
Yeah.
What's the complexity there?
Right. Double materiality. It is a key concept, and yes, it drives a lot of the complexity. It means companies aren't just required to report on how ESG factors might impact their own financial performance, their bottom line. That's sometimes called financial materiality or single materiality.
Okay, the outside-in perspective, how the world affects the company.
Exactly. With double materiality, they also have to report on the flip side, how their own activities and operations impact people and the environment, the inside-out perspective.
I see. So it's not just risk to the company, but also impact by the company. Both sides of the coin.
Both sides. And this isn't just some technical term, it signals a really fundamental shift. Companies are now accountable for both their financial exposure to ESG stuff and their actual real-world impact on the environment and society. It's a true game changer in corporate responsibility thinking.
It really forces a broader perspective.
It does, and it requires a much more comprehensive analysis and reporting effort. Companies need to look both inwards at their risks and outwards at their impacts.
Which must lead to a huge range of disclosures.
Absolutely. It leads to a wide range of required disclosures. You've got the quantitative KPIs. People often talk about greenhouse gas emissions, water usage, maybe the gender pay gap.
Measurable stuff.
Right. But it also requires much more qualitative information, things about their policies, their due diligence processes, how they engage with stakeholders. It's not just numbers.
And it's not as simple as just sticking this all in a glossy, separate sustainability report anymore, is it?
No, that's another really key shift. The reporting must now be digitally tagged using XBRL.
XBRL, like they use for financial reporting.
Exactly the same tech. It allows for much easier machine reading, analysis, and comparison of the data across companies.
Makes sense for handling data from 50,000 companies.
Definitely. And crucially, this information needs to be integrated into the company's main management report. It can't be just a standalone, potentially sideline document.
Wow. That really signals a commitment, embedding it right into the core business reporting, not just an add-on.
It does. It elevates the importance. And just like with financial reporting, there's now an expectation, in fact, a requirement leading to the assurance for companies to have proper internal controls in place.
Internal controls for ESG data.
Yes. To ensure the quality, the accuracy, the reliability of their ESG data, it needs to be trustworthy.
This all sounds like it's moving way beyond voluntary nice-to-haves into something much more, well, serious and legally enforceable. Is it actually legally binding? What happens if companies don't comply?
Yes, absolutely. It is legally binding. The CSRD is an EU directive. That means each member state has to transpose it, basically write it into their own national laws. They were meant to do that by mid-2024.
Okay, so national laws will enforce CSRD.
Correct. The EU taxonomy, on the other hand, is an EU regulation. That makes it directly applicable law in all member states automatically without needing separate national laws.
So slightly different mechanisms, but the same result, binding rules.
Exactly. Gone are the days when sustainability reports were maybe just for PR or attracting certain investors. These are now legally enforceable obligations with real teeth. It signals a very serious commitment from the EU.
So there's no real wiggle room there for the companies in scope. And what are the potential consequences then? What are the teeth?
Well, noncompliance can lead to a range of penalties. We could certainly see regulatory fines and other sanctions imposed by the relevant national authorities in each country.
Okay, fines.
There's also the potential for legal actions, maybe from investors, NGOs, or other stakeholders who feel they've been harmed or misled due to inadequate or inaccurate reporting.
Right, litigation risk.
And, of course, maybe less direct, but hugely powerful in today's world, the reputational risk.
Right.
Failing to meet these standards, being called out for it.
Yeah.
That can be incredibly damaging.
Yeah, no company wants to be seen as lagging behind, or worse, greenwashing, especially when the rules are clear. And that mandatory external assurance you mentioned, that verification step, how does that factor into enforcement and credibility?
That's a really critical element for credibility. The CSRD mandates that the reported sustainability information must be externally assured, checked by an independent party.
Like an auditor.
Yes, typically an accredited auditor or assurance provider. Initially, this will start with what's called limited assurance.
Limited meaning.
Limited assurance provides a sort of moderate level of confidence in the data. It's less intensive than a full financial audit. But the plan is eventually to move towards reasonable assurance.
And reasonable assurance is?
That's a much higher level of verification, much more rigorous, very similar to the level of assurance we expect for financial audits. It means a high degree of confidence in the reported information.
Okay, so phasing in the level of scrutiny over time. But the direction is clear towards financial grade verification.
That's the trajectory. So this really does represent that fundamental shift we talked about, moving away from often voluntary, sometimes narrative-heavy ESG reports towards regulated, verified, and comparable data. It's really aiming for the same kind of trust and reliability we generally place in audited financial statements.
That's a very powerful comparison, bringing that same level of rigor to sustainability information that we've long had for financial data.
It's a huge step in that direction.
Now, the expert overview we looked at, it touched on some of the challenges these new regulations present. Interestingly, it focused quite a bit on the challenges for, like, audit firms themselves. Does this focus on auditors maybe suggest that the level of expertise required across the board, not just for auditors, for effective ESG reporting and assurance, is maybe significantly higher than what's readily available right now?
That's a great point. Even though the source zeroes in on audit firms, the challenges they face really do highlight the broader shifts and potential bottlenecks happening. Well, for instance, the talent gap they mention in ESG expertise. That's not just an issue for auditors finding qualified staff. It suggests a much wider need across industries for professionals who actually understand these complex environmental and social issues and the new reporting rules.
Right. Companies themselves will need people internally who can gather the data, analyze it, report it correctly,
Ah,
and there might not be enough of those experts around yet.
exactly. It's a bottleneck for everyone. Similarly, the training needs. They identify needing to understand the new ESRS standards that hold double materiality concept, the specific assurance standards like ISA 3000.
Yeah.
That points to a significant learning curve, not just for auditors, but for finance teams, sustainability teams, consultants, maybe even boards within companies.
So it's not just auditors needing to quickly get up to speed. It's a much broader upskilling challenge across the business world.
Absolutely. And it's not just people, it's systems too. The source mentioned technology gaps.
Oh,
The lack of readily available, sophisticated software tools specifically designed for gathering, managing, analyzing, and reporting complex ESG data, especially data that needs to be assured. That indicates a broader need for innovation and investment in new tech solutions.
so the tools need to catch up with the regulations.
In many cases, yes. And the concern raised around assurance readiness, basically, are companies even ready to have this data scrutinized to that level? That really underscores the higher bar for credibility now. Everyone involved, whether producing the data or using it, needs to be confident in its reliability.
That makes sense.
Yeah.
And the point about client pressure. I imagine that means even smaller businesses, maybe those not directly caught by CSRD in the first wave,
Yeah.
they'll likely start feeling the ripple effects anyway,
Yeah.
as their larger customers who are in scope start demanding more detailed ESG information from their suppliers.
Precisely. That's almost certain. The demands for transparency and accountability will cascade down through supply chains and value chains. It won't just be the 50,000 companies directly affected.
Okay, so it spreads. Now, while these regulations might seem like, a massive compliance headache for many,
Which they can be.
the expert source we looked at also framed this as a potential strategic opportunity,
Yeah.
especially for those who really understand these changes. How can businesses or even individuals view this as an opportunity rather than just another burden, another set of rules to follow?
Well, the argument, and I think it's a strong one, is that as these regulations become more embedded and widespread, there's going to be a huge need for credible expertise. People and firms who can help companies navigate this complexity.
Right, the advisors, the consultants, the tech providers.
Exactly. But also internally within companies.
Yeah.
So for those who proactively engage with ESG now, whether that's individuals looking to develop new skills in this area or businesses looking to get ahead of the curve, maybe integrate this properly into their strategy, there's a real chance to establish a strong position. You're positioning yourself for a landscape that is clearly rapidly evolving in this direction. It's about understanding where business and regulation are heading.
It's almost like turning a potential hurdle into a competitive advantage. Being ready, being knowledgeable, maybe even finding efficiencies or innovations through that ESG lens while others are just scrambling to comply.
That's exactly the idea. Being ahead of the curve in a world that is undeniably increasingly focused on these environmental and social issues, driven now by hard regulation in the EU.
Yeah.
And the expert source even pointed out that many existing skills, particularly analytical skills like those used in finance or traditional auditing, are highly transferable and applicable to this field of sustainability reporting and analysis.
Ah, interesting. So it's not always about starting completely from scratch.
Not necessarily. For many professionals, it might be more about adapting and expanding their existing knowledge base to incorporate these new ESG dimensions and reporting standards, leveraging what they already know.
Okay, that's a more encouraging way to look at it, perhaps.
Yeah.
So let's try to wrap things up. If we were to distill this, what are the absolute key takeaways you think everyone listening should be keeping in mind about these significant EU regulations, CSRD, and the taxonomy?
Okay, the big picture, I'd say, is this. CSRD and the EU taxonomy are genuinely transformative EU regulations. They are significantly ramping up the scope, the detail, and the rigor of ESG reporting requirements.
Ramping up is right, given that 50,000 number.
Definitely. They introduce mandatory external assurance to try and ensure the credibility of that data. And they aim to define and standardize through the taxonomy what actually counts as a sustainable or green economic activity based on scientific criteria.
And that concept of double materiality seems absolutely central.
It is. Don't forget that. Companies are now clearly on the hook for reporting both the financial risks to them from ESG factors and their own impact on the environment and society. That dual perspective is key.
And it's also crucial to remember, right, that these frameworks aren't set in stone. They are complex, yes, but they're also actively evolving as the EU pushes forward with its broader Green Deal ambitions.
Absolutely critical point. This is not static. We've seen the first big steps, but standards will be refined, the taxonomy will expand. Staying informed isn't just, helpful, it's rapidly becoming essential for anyone operating in or connected to the EU market.
It's an ongoing story.
It really is an ongoing area of development, so keeping an eye on updates from the EU, from EFRAG, is going to be important.
Okay, so here's maybe a final thought for you, the listener, to mull over. With this clear increasing demand for transparent, for verified ESG data, how might that fundamentally reshape business decision-making and maybe even investment strategies in the years ahead?
Good question.
And beyond that, what role could your understanding of these frameworks, CSRD and the taxonomy, play in navigating that future? Whether you're running a business, making investments, working within a company, or even just trying to understand the direction the world is heading, something to really think about. Ever feel like sustainability reporting is just a maze of acronyms and requirements?
Absolutely.
You're definitely not alone. Today on A Deep Dive, we're trying to cut through some of that complexity. We're looking at the European Sustainability Reporting Standards, ESRS.
Right.
And our focus today is ESRS 1, kind of the rule book that governs the whole thing.
Yeah, if you're feeling a bit lost in the weeds of sustainability disclosure, you're definitely in the right place. Think of this as maybe a shortcut, a way to grasp what really matters in ESRS 1.
The essentials?
Exactly, the core principles that, should help unlock the rest of the standards.
Right. We've been digging into the actual ESRS 1 document, and, well, it's not exactly beach reading.
No, not quite.
But it really is the foundation. Understanding ESRS 1 feels like learning the grammar of sustainability reporting. It makes everything else make a lot more sense.
That's a great way to put it. Consider ESRS 1 the essential toolkit. You kind of need it before you can even think about building anything else. So our mission today is just to explain those fundamental tools, those core concepts, really clearly, so you can hopefully navigate this landscape of European sustainability disclosure with a bit more confidence.
Okay, great. So ESRS 1 is the starting point. But where do these standards even come from? What's the bigger picture?
Well, the ESRS are structured around three main categories. First, you've got the cross-cutting standards. As the name suggests, they apply to pretty much everyone.
Okay.
Then there are topical standards. These focus on environmental, social, and governance issues, E, S, and G.
Right, the familiar ESG.
Exactly. And finally, there are sector-specific standards, which are tailored to particular industries.
Cross-cutting, so ESRS 1, that fits into that first bucket.
Precisely, yeah. Cross-cutting standards, specifically ESRS 1 and ESRS 2, are mandatory for all undertakings. Doesn't matter what sector you're in or which specific sustainability topic we're talking about.
Everyone has to follow these.
Yes. And ESRS 1 specifically is all about setting the general rules, how companies should prepare their sustainability info, how they should present it. Think of it as like establishing the common reporting language.
Right. And then when we get into those other standards, the topical and sector-specific ones, what are the main things companies are looking at there?
So those standards are generally organized around four key reporting areas. First is governance, how the company is actually run.
Okay.
Second, strategy, their overall approach to sustainability. Third is impact, risk, and opportunity management, how they handle these kinds of issues.
IROs, as they call them later.
Yes, exactly, the IROs. And finally, metrics and targets, the numbers, the quantifiable stuff, how they measure performance. This structure really aims for a comprehensive view of a company's sustainability profile.
And ESRS 1 itself lays down some ground rules for what needs to be in there, even at that high level.
It does. While ESRS 2 gets into the really detailed minimum disclosure requirements, MDRs, they call them, for policies, actions, targets, that's MDR-P, and for metrics and targets, MDR-T.
Okay. ESRS 1 emphasizes that fundamentally, companies must report on their policies and their metrics and targets, specifically related to the sustainability issues they've decided are significant or material. I have a feeling that's a word we're going to come back to quite a bit.
Oh, definitely.
But before we dive into materiality, the document mentions some drafting conventions. What's that about? Are they important?
Yeah, they're worth noting. Think of them as the document's own little style guide. For instance, if you see a term in bold italic,
Like that.
exactly like that, it means it has a specific defined meaning within the ESRS framework itself, or maybe in related regulations. It's like a built-in dictionary just to make sure everyone's using key terms the same way.
That makes sense. Avoids confusion. Anything else in this guide we should look out for?
Absolutely. Pay close attention to how they define impacts. It's broader than you might think.
How so?
It's not just about the negative stuff, the problems. The ESRS uses impacts to mean both positive and negative sustainability-related effects that come from a company's activities. So it covers their influence on people and the environment. It's a much wider lens.
Okay, so the full picture, cause and effect, good and bad. Got it. And what about risks and opportunities? How are they framing those?
So risks and opportunities in the ESRS context are specifically about financial risks and opportunities related to sustainability.
Ah, financial. Oh, yeah.
These come from a company's dependence on resources, natural, human, social capital, and how changes in those areas or broader sustainability trends could affect the company's finances, its future value. This is really a core part of that double materiality idea we need to talk about.
Right, the famous double materiality. Okay. And then there's this combined term they use a lot, impacts, risks, and opportunities, or IROs. What's the point of that shorthand?
IROs, yeah. Impacts, risks, and opportunities. It's basically the go-to term used all through the standards, and it's there to constantly remind us of that double materiality perspective.
It forces you to always keep both sides in mind. The company's effect on the world around it and how sustainability issues affect the company itself. It keeps that balance. Got it. So as companies are putting all this sustainability information together, what makes it good information? What qualities does it need to have to actually be useful?
ESRS 1 talks quite a bit about these qualitative characteristics. There are two fundamental ones: relevance and faithful representation.
Fundamental meaning.
Meaning, if the information doesn't have these two qualities, it's basically useless for decision-making.
Okay. Relevance seems pretty straightforward. It needs to matter to the people reading it, help them make decisions.
Precisely. It needs to be pertinent, relevant to the needs of the users of the sustainability statement, help them assess the company's past performance, its future prospects, all related to sustainability.
And faithful representation.
Faithful representation means the information needs to be complete, neutral, so unbiased, and free from significant error. It has to accurately reflect the reality it's claiming to represent. No sugarcoating, no major mistakes.
Okay. And beyond those basics, are there things that make the information even better, like bonus qualities?
Exactly. They call these the enhancing qualitative characteristics. There are three: comparability, verifiability, and understandability.
Comparability, like comparing company A to company B.
Exactly. Or comparing company A this year to company A last year. It lets stakeholders see things in context. Verifiability means that, different knowledgeable people looking at the same evidence should be able to agree that the information is faithfully represented. It's not just one person's opinion.
Right, it can be checked.
And understandability is just what it sounds like. The information needs to be clear, concise, presented in a way that reasonably informed users can actually grasp what it means.
Okay, all those make perfect sense. You need these for the info to be credible and useful, not just, a PR exercise.
Absolutely. No greenwashing allowed.
Right. Now, let's tackle the concept that seems to underpin everything: double materiality. This feels absolutely central.
It is. It's really the bedrock of ESRS disclosures. It's fundamentally a two-pronged approach. You have to look at both impact materiality and financial materiality. Getting this distinction clear is, crucial.
Okay, let's take impact materiality first. What does that cover?
Impact materiality is all about the undertaking's impacts, actual or potential, on people and the environment, both positive and negative impacts.
Okay.
So a sustainability matter is considered impact material if the company's activities cause or could cause significant consequences out there in the world. And significance is judged by things like the scale of the impact, its scope, and whether it's irreversible or hard to fix. It's really about the company's footprint.
So it's outward looking. How the company affects the world, not just how the world affects the company.
Precisely. And then you have the other side, financial materiality. Financial materiality looks inwards. It examines how sustainability matters affect the company's financial performance, its cash flows, its access to funding, its overall enterprise value.
Okay.
This includes both the financial risks and the financial opportunities that arise from sustainability issues, like the rising cost of carbon emissions. That's a financial risk. Developing a new, super popular, sustainable product. That could be a huge financial opportunity.
So financial materiality is about how sustainability hits the bottom line, or could hit the bottom line, and affects the company's long-term financial health. How do these two concepts, impact and financial, work together under this double materiality banner?
This is a really key point. A sustainability matter is considered material, and therefore you must disclose information about it under ESRS if it meets the criteria for either impact materiality or financial materiality. Or, of course, both.
Oh, right. So it doesn't have to be both.
No, it just needs to qualify under one of those perspectives to trigger the reporting requirement.
That feels like a really significant distinction. So
Yeah.
even if, say, polluting a river doesn't pose an immediate financial threat to a company, maybe cleanup costs are low for now.
Yeah.
If it has a significant negative impact on the environment or local communities, it's still material and needs reporting.
Exactly right. And that really reflects the EU's broader thinking on sustainability. It's acknowledging that companies have responsibilities beyond just, making money for shareholders. There's accountability for wider societal and environmental impacts.
Okay, that makes sense. But it raises the question, who decides what's material? Is that just the company looking inwards, or?
No, it's not purely an internal decision. ESRS puts a lot of weight on stakeholders and their role in this whole materiality assessment process.
Stakeholders.
Yeah.
Who exactly does that include?
They define stakeholders pretty broadly. Basically, anyone who is affected or could be affected by the company's activities. This breaks down into two main groups. First, you have affected stakeholders, people or environments directly or indirectly impacted. Think employees, local communities, maybe even future generations. And second, you have the users of sustainability statements. These are primarily the users of general-purpose financial reporting investors, lenders, insurers, people who need this sustainability information for their own economic decision-making.
So it's not just what the CEO or the board thinks is important. You actually have to consider the perspectives of people on the ground, those affected by what the company does.
Absolutely. In fact, the standards say that engaging with affected stakeholders is pretty central to properly assessing impact materiality. You need to listen, understand their concerns, their experiences, to get a clear picture of your real-world impacts.
Makes sense.
And at the same time, you need to consider what information those users, the investors, and others actually need to make informed financial decisions about the company's sustainability, performance, and risks.
And this process, considering both the affected groups and the users of the information, that's what leads to identifying these material matters.
Exactly. A material matter is just a sustainability topic. Could be climate change, biodiversity, worker rights, whatever that is considered material from either the impact perspective or the financial perspective or both. And the outcome of doing that whole materiality assessment is what dictates the specific information a company has to disclose under the ESRS.
Okay, so materiality is the compass. It guides what gets reported. Now, another term that comes up is due diligence. How does that fit into ESRS and sustainability reporting?
Due diligence is a really fundamental concept for responsible business conduct, and it's tightly linked here. It's essentially the process, the steps a company takes to identify, prevent, mitigate, and then account for how it addresses its actual and potential negative impacts.
Negative impacts on
People and the environment.
Yeah.
And it also includes managing the related financial risks and opportunities that stem from those impacts. Think of it as a proactive risk management system, but specifically focused on sustainability issues.
So it's about having systems in place to try and stop problems from happening, not just reporting on them after the fact.
Exactly. It's proactive management. And the core elements of this due diligence process are actually embedded within ESRS 2, that's the standard, with general disclosures for everyone, and also within the more specific topical ESRS standards. So the standards expect companies not just to report on their material IROs, but also to show that they have, robust due diligence processes in place to actually manage them effectively.
Right, you have to show your work, not just the final answer.
Okay.
Another key term, value chain. How wide does that net cast in ESRS reporting?
The value chain is defined pretty broadly. It covers all the upstream and downstream activities related to a company's own operation.
Upstream and downstream.
Meaning it includes all its business relationships, direct and indirect. So upstream would be your suppliers, their suppliers, maybe raw material extraction. Downstream includes things like distribution, the use of your products by customers, and even end of life, like disposal or recycling. It's meant to be a holistic view.
Wow, okay. That sounds huge. How far down that chain does the company really need to look?
Well, the ESRS requirement is that the sustainability statement has to include information about both the company itself and its value chain whenever you're talking about material impacts, risks, and opportunities.
Why so broad?
Because it acknowledges that often a really significant chunk of a company's total sustainability footprint, its emissions, its social impacts, actually lies outside its own factory gates or office doors. It's in the supply chain or in how products get used.
Okay, that makes sense logically.
Yeah.
But practically speaking, getting reliable data from your entire global value chain, that sounds like a nightmare for big companies.
You're absolutely right. It can be a major challenge. And the ESRS does recognize this. It allows for estimations to be used in certain situations.
Estimations.
Yeah, particularly in the first few years of reporting.
Yeah.
Companies might need to rely on things like industry sector averages or other reasonable proxies when getting direct primary data from every single supplier or customer just isn't feasible straight away.
Okay, so there's some pragmatism baked in, at least initially.
There is, but the expectation is definitely that companies will work to improve the scope and the accuracy of their value chain information over time. It's not an excuse to do nothing.
Got it. Okay, let's shift gears slightly to talk about time. How do different time horizons play into this reporting?
Thinking about different timeframes is really essential for understanding sustainability issues properly.
No.
ESRS 1 stresses that companies need to report on their impacts, risks, and opportunities, those IROs again, over the short, medium, and long term.
And how do they define short, medium, long?
They give some general guidance. Short term is typically seen as up to 1 year. Medium term is usually between 1 and 5 years. And long term is generally considered anything beyond 5 years.
So companies really need to look beyond just the next quarter's results.
Precisely. It forces a longer-term perspective. And importantly, the reporting periods for the sustainability statement itself has to align with the company's financial reporting period, usually annually. Furthermore, the ESRS requires companies to connect the dots in their statement, link their past sustainability performance, where they are now, and what their future outlook is. And if they set specific sustainability targets, they also need to show their progress against a clearly defined baseline year. Track the change.
That longer-term view and tracking progress seems vital for showing real commitment, not just one-off initiatives. Okay, let's talk about actually putting the report together. What are some key rules for preparing and presenting all this sustainability information?
There are several important points. First off, there's a big emphasis on providing comparative information. You need to show data from previous reporting periods alongside the current year's data.
Why is that?
So stakeholders can actually track performance over time, see trends, see if things are getting better or worse. It provides crucial context.
Makes sense. What else?
Second, if a company has to use those estimations we talked about, or if there's significant uncertainty around some of the data they're reporting, they have to be upfront about it. They need to clearly disclose the sources they use for estimations and explain the nature of the uncertainty. Transparency is key.
So no hiding behind fuzzy numbers. You have to explain them.
Exactly. What else? Companies also need to update their disclosures if significant sustainability-related events happen after the reporting period ends, but before the statement is actually finalized and published.
Like a major environmental incident or something?
Potentially, yes. Also, there are specific rules for how to handle and correct any errors found in reports from previous years. Gotta fix mistakes transparently.
Yeah.
ESRS 1 also lays out principles for consolidated reporting. Generally, a parent company reports for its entire group, though there are some limited exemptions for certain subsidiaries in specific cases.
And what happens if a company has information that's genuinely, like, commercially sensitive or classified? Do they still have to publish it?
That's a good question. The ESRS does allow for omitting truly classified or highly sensitive information, but only in very specific limited circumstances. It's a high bar.
And they have to explain why.
Yes. If they choose to omit something on these grounds, they have to clearly state that information has been omitted and explain why. And one final point here. Remember, it's not just about risks and negative impacts. The ESRS explicitly requires companies to report on relevant sustainability-related opportunities as well.
Right. The potential upsides of being more sustainable. It's about the whole picture.
Exactly. The full spectrum.
Okay, so once all this information is gathered and prepared, according to these rules, where does it actually live? Is it just buried in the annual report somewhere? Is there a specific structure required?
Good question. No, it shouldn't be buried. The ESRS requires the sustainability information to be presented in a clearly identifiable dedicated section of the company's management report called the sustainability statement.
A distinct section.
Okay. Yes. And while there's some flexibility in the exact format, ESRS 1 does provide guidance on the expected content and structure. Appendix F, for example, actually gives an illustration, a sort of template for how a sustainability statement could be structured. That can be a really helpful reference.
So it needs to be easy to find and follow a logical structure.
Precisely. And furthermore, ESRS stresses the need for clear connections, clear linkages between the sustainability statement and other parts of the company's corporate reporting.
Like the financial statements.
Exactly, like the main management report discussion and the financial statements themselves. Where it makes sense, companies are encouraged to use cross-referencing linking back and forth to avoid just repeating information and to ensure the whole report tells a cohesive story.
Okay, that makes sense, integrating it all. Now, given that this is all pretty new and complex, does ESRS 1 offer any breathing room, any transition time for companies just starting out?
Yes, it does. There are indeed transitional provisions built in. These apply particularly to certain disclosures that might be harder to implement immediately, like some entity-specific details or aspects related to getting that detailed value chain information.
Ah, the value chain again?
Yes. Appendix C of ESRS 1 actually lists these specific phased-in disclosure requirements. So for certain things, some companies might get a bit more time, maybe a year or two or three, depending on the requirement and the company size, to fully comply. It acknowledges that building these robust reporting systems takes time and effort.
That's good to know. A bit of a runway for companies to get properly up to speed.
Okay.
Okay, wow. We have covered a huge amount of ground on ESRS 1.
We certainly have.
For our listeners trying to process all this, what would you say are the absolute must-remember key takeaways from ESRS 1?
Okay, the big ones. First, remember ESRS 1 sets the stage, the fundamental principles for all the other ESRS standards. It's the foundation. Second, that concept of double materiality, it's absolutely central. You have to consider both the company's impact on the world and how sustainability impacts the company financially. That determines what gets reported.
Impact and financial materiality.
Got it. Third, stakeholder engagement is crucial, especially for understanding your impact materiality. You need to listen to those affected.
Okay.
And finally, the quality of the information matters. It needs to be relevant, it needs to faithfully represent reality, and it needs to be presented clearly, comparably, verifiably, basically. It needs to be useful and credible.
So it sounds like whether you're involved in, say, business strategy, or you're making investment decisions, or maybe you're just trying to understand how businesses are evolving in society, grasping these fundamentals of ESRS 1 is pretty vital right now.
Absolutely vital, especially for navigating this whole landscape of increasing corporate transparency. It's not going away.
Definitely not.
And look, for anyone who really wants to dive even deeper, I highly recommend actually exploring the appendices in the ESRS 1 document itself. Appendix A has more on the application requirements. Appendix B digs into those qualitative characteristics.
And you mentioned those.
And as we discussed, Appendix C lists the phase-ins, and Appendix F gives that example structure. They're genuinely useful.
Fantastic. Always good to have pointers for more exploration. And maybe on that note, here's a final thought for you, our listeners, to ponder. As sustainability reporting under standards like ESRS continues to mature and become more widespread, how do you think the information that gets disclosed will ultimately change our understanding of corporate responsibility? And maybe even transform how we think about creating long-term value, not just for shareholders, but for, the environment and society too?
That's a big question.
It is. Something worth keeping in mind as this all unfolds.
Welcome to the Deep Dive. Today, we're navigating the European Sustainability Reporting Standards, specifically ESRS 2. Think of this as the sort of foundational blueprint for how companies across Europe will now report on their sustainability efforts.
Exactly.
We've got the standard itself right here, and our mission today is really to pull out the essential framework, its structure, the core ideas, so you can grasp the fundamentals.
Yeah, absolutely. Because while, later standards will get into the nitty-gritty of environmental impacts or social stuff, ESRS 2 really lays the groundwork.
Okay.
It's the general standard. It dictates how companies should present their sustainability information. So, yeah, it's a crucial starting point.
Okay, so let's unpack this blueprint then. The document, it seems pretty logically organized.
It is, yeah.
It starts with objectives, then moves into the core, these general disclosures covering things like how the report was put together, who's actually in charge of sustainability inside the company.
The governance aspect.
Yeah, governance, their overall strategy, how they tackle impacts, risks, opportunities, and then finally, metrics and targets, plus some appendices.
Detailed guidance in those.
So where's the best place to start exploring this foundation?
Well, I think the natural starting point is the basis for preparation.
Okay.
This section essentially tells you how to read the rest of the sustainability statement. Its main goal is to make sure you understand what the company's reporting on, what its
Right.
boundaries are,
Right.
and how far into its network, its value chain, it's actually looking.
So it's not just the company's like direct operations, it's suppliers, maybe even customers.
Precisely.
Hmm.
A company needs to state clearly, is this report just for the parent company, or is it a larger consolidated group?
Makes sense.
And they also need to define the reporting period, obviously. But importantly, they also have to specify what they consider short-term, medium-term, and long-term horizons.
Ah.
And explain why they chose those definitions. Because, you can imagine different industries.
Yeah, mining companies long term is probably very different from a tech startups, right?
Exactly. That's a key point. Different perspectives entirely.
What else is covered in this preparation part?
The value chain is a really big piece. If a company's using estimates for data related to its value chain.
Which must happen a lot, surely. Getting precise data from everyone.
Oh, absolutely. It's often the case. So if they are estimating, they need to be upfront about it.
How upfront?
Well, they need to detail which metrics are estimated, the methods they used, their own assessment of how accurate those estimates probably are,
Yeah, okay.
and crucially, their plans for improving that data quality down the line.
Right. So if they're guessing the carbon footprint of raw materials, they have to say, we guessed, here's how, and here's how we'll get better numbers next time.
That's exactly it. And this transparency, it extends to all the quantitative and financial figures in the report.
Okay.
They have to disclose the sources of their estimates and highlight any significant uncertainties that could affect the numbers.
That feels important. Sustainability data isn't always as neat as financial data.
It often isn't, no.
Yeah.
It involves more assumptions, less readily available info sometimes.
Yeah.
So that uncertainty disclosure is key.
Right. What about changes? If a company reports differently one year compared to the last?
Yes, that's covered too. If there are changes in how they prepare or present the information compared to previous reports, they need to explain what changed, why, and crucially, how it impacts any comparative figures they show.
Okay.
And similarly, if they find, significant errors in past reports, they need to disclose and correct those too.
It sounds like they're aiming for consistency, comparability over time, so you can actually track progress.
That's the goal. Building trust, making sure companies aren't sort of moving the goalposts constantly.
Makes sense.
And to help with that, they also need to state if their reporting is influenced by other laws or, well-established sustainability reporting guidelines.
Like GRI or something.
Potentially, yeah. If so, they need to clearly reference those specific sources. And there's also something called incorporation by reference,
Okay.
where they can point you to information they've already disclosed somewhere else, like maybe their annual financial report. But they have to be really precise about which specific ESRS data points they're referencing.
Like footnotes almost. Avoiding repetition, but keeping it complete.
Exactly. Cross-referencing, essentially, keeps things efficient.
Now, I think I saw something about smaller companies getting a bit of a break.
Yes, that's right. There are phase-in provisions, specifically for undertakings with fewer than 750 employees.
Okay. What can they skip?
Well, to ease the burden initially, for a limited time, they can omit certain disclosures. Things like a detailed breakdown of their business model and value chain, specific targets they've set, and detailed info on policies and actions.
That seems practical. Acknowledging resource constraints for smaller players?
Yeah, it's a pragmatic approach, trying to bring everyone along without overwhelming the smaller ones right at the start.
Okay, so we've laid the foundation how the report's put together.
Yeah.
What's the next pillar in ESRS 2?
The next really crucial section is governance.
Right.
This shifts the focus. It's about who within the company is responsible for sustainability and how they make sure it's managed effectively.
So oversight.
Oversight, processes, controls, procedures, basically understanding the internal machinery for managing sustainability.
So who is steering the ship on these issues? What kind of oversight are we talking about?
Exactly the right question. The standard requires companies to disclose information about their administrative, management, and supervisory bodies.
So the board, the executive team?
Essentially, yes.
Uh-huh.
Details about who's on these bodies, diversity aspects, including gender balance, their expertise in sustainability.
Do they actually know about this stuff?
That's what the disclosure aims to reveal. Do they have people with relevant backgrounds? And critically, how do they actually oversee sustainability? Companies need to explain the roles, the responsibilities,
Okay.
and how these bodies make sure the company's impacts, risks, and opportunities related to sustainability are properly addressed.
And how do they ensure that? Just saying they oversee it isn't enough,
Yeah.
presumably.
No, not at all. The company has to describe the specific processes they have for managing these material sustainability issues.
Right.
This also includes explaining what kind of sustainability information regularly goes to these governance bodies and how often.
So is sustainability actually on the board's agenda?
That's what you should be able to tell. Is it integrated into top-level discussions and decisions, or just siloed off somewhere?
Okay. What about linking pay to this? Executive incentives, that's a hot topic.
It absolutely is, and it's covered here. ESRS 2 requires companies to disclose whether they integrate sustainability performance into incentive schemes for these top bodies.
Ah, interesting.
And if they do, they need to describe the main features of those schemes. Is performance judged against specific sustainability targets? What proportion of pay is linked to hitting those goals?
Wow. That could really drive change, couldn't it? If a chunk of the bonus depends on hitting, say, emissions targets.
It's designed to. Aligning financial incentives with sustainability objectives,
Yeah.
it's potentially a very powerful lever.
What else falls under this governance umbrella?
They also need a statement on their due diligence processes for sustainability matters,
Due diligence, meaning?
meaning the steps they take to identify, prevent, mitigate, and account for their potential negative impacts on people, on the environment, across their whole value chain.
Okay, so their process for avoiding harm.
Essentially, yes. And finally, under governance, they need to disclose the main features of their risk management and internal control systems, specifically as they relate to sustainability reporting.
Ah, so ensuring the data itself is reliable and risks are managed.
Exactly. It's not just about identifying sustainability risks, but having solid systems to manage them and ensuring the integrity of the sustainability information they publish.
What sort of detail do they need on those systems?
They need to explain the scope, their risk assessment approach, the specific risks identified and mitigation plans, how these processes are integrated into overall operations, and how often they report on all this to the governance bodies.
Provides transparency on how seriously they're taking it all?
Precisely. How robust are their internal controls around this?
Okay, so we've got basis for preparation, then governance. The next big one is strategy, right? This feels like where we see the company's vision.
Exactly right. The disclosures in the strategy section are all designed to give you a clear understanding of the company's overall strategy and, crucially, how sustainability fits into it.
Is it bolted on or baked in?
That's the question it helps answer. How does sustainability relate to their business model, their entire value chain? Is it core to their long-term thinking?
So it's the big picture. Sustainability isn't just a side project, but woven into the business purpose, the future plans.
That's the ideal, yes. Companies need to disclose the specific elements of their main strategy that either relate to or significantly affect sustainability matters. And this also includes explaining how they consider the perspectives and concerns of their stakeholders when you're actually forming that strategy.
Stakeholders being employees, customers, investors, communities, anyone with a stake.
Yes, exactly, that broad group.
Yeah.
Furthermore, they need to explain the outcomes of their assessment of their most significant sustainability impacts, risks, and opportunities.
The materiality assessment we'll likely talk more about.
Yes. And critically, how those findings actually shape their strategy and their fundamental business model.
Give me an example.
Sure. If a company identifies, say, a major climate risk to its supply chain in that assessment, this strategy section should explain how they're adapting their strategy in response. Maybe shifting sourcing, investing in resilience.
Right. Or if they spot a huge water scarcity risk where they operate, they need to show how that influences strategic decisions about growth or resource use there.
Precisely. Then there's some more specific disclosure requirements about strategy, business model, value chain. They need to describe their main product service groups, key markets, customer groups, geographical areas, workforce distribution.
Sort of painting the operational landscape.
Exactly. Give context. They also need to break down their total revenue by significant industry sectors, as defined by ESRS,
Okay.
and list any other significant ESRS sectors their activities touch upon, focusing on what's material for them. And there are specific requirements if they operate in certain high-impact sectors.
Like fossil fuels.
Fossil fuels, chemicals production, controversial weapons, tobacco.
Yeah.
If they're involved there, specific disclosures kick in.
That makes sense. A targeted approach.
Yeah.
What about their ambitions? Their sustainability goals?
Yep. They need to clearly disclose their sustainability-related goals and targets, reduce emissions X% by Y date,
Mm-hmm.
and then explicitly explain how their overall business strategy aligns with achieving those goals.
Right.
They also need to assess their current major products, services, markets.
Are those things actually compatible with their stated goals?
That's the question. Are they helping or hindering progress towards those goals? Do they need to change fundamentally?
That's a searching question for a company to answer publicly.
It is. And related to that, they need to discuss their strategy's resilience to sustainability challenges.
Yeah.
What major hurdles do they foresee? What solutions are they exploring?
How prepared are they?
Exactly. And finally, a clear description of the business model and the whole value chain inputs, outputs, key suppliers, customers, distribution, and how they create value, financially and otherwise, over the short, medium, and long term.
Wow, that is a really comprehensive look at how sustainability should knit into their core business thinking. Now, you mentioned stakeholders earlier. There's a specific section just on that.
Yes, absolutely. Interests and views of stakeholders gets its own focus in ESRS 2.
Okay.
The requirement here is for the company to clearly explain how its strategy and business model actually consider and incorporate stakeholder interests and views.
So not just listening, but showing how it influences things.
Exactly. It's not enough to say, we held a consultation. They need to show how that engagement actually shaped their plans, their business model.
How do they show that?
They need to summarize their stakeholder engagement, who they talked to, how, explain their understanding of the key interests and views expressed.
Mm-hmm.
And crucially, link these views back to their strategy and business model, especially informed by that materiality assessment, what's important to stakeholders and the company.
And if engagement led to changes...
Disclose those changes. And importantly, explain how the leadership, the board, management, are kept informed about these stakeholder perspectives.
Creating a feedback loop, almost, making sure those voices influence decisions at the top.
That's the principle, yes. A formal channel for influence.
Okay. So building on understanding the business and stakeholders, the next section gets into the specifics. Material impacts, risks, and opportunities, and their interaction with strategy and business model.
Right. This is where the abstract concepts start to become really concrete.
Because here, they connect the specific sustainability issues they've flagged as important.
The material one.
Yeah, material ones, with their overall strategy and day-to-day operations.
Precisely. They need a concise description of the material impacts, risks, and opportunities from their materiality assessment. And like we said, this links back to another standard, IRO 1, which has the detailed how-to for that assessment.
Got it.
Then they need to elaborate on the current and anticipated effects of these material items on their business model, value chain, strategy, even their financial planning.
So how do these big sustainability issues actually hit the company's bottom line, its operations, its future prospects, now and looking ahead?
Exactly. How do material impacts, negative and positive, affect people and the environment, short, medium, long term?
What are the financial consequences of material risks and opportunities?
Like the potential costs of climate change adaptation or the financial upside of sustainable products. Precisely those kinds of things. Plus, information about the resilience of their strategy and business model to these material risks and opportunities.
How well prepared are they?
How shock-proof are they? Can they weather the storms and seize the opportunities from sustainability trends?
That's the core question this disclosure tries to answer. Companies also need to highlight any changes in their material items compared to the last report. How are things evolving? And finally, specify which of these material impacts, risks, and opportunities are also covered in more detail by other specific ESRS standards, reinforcing that interconnectedness.
It's definitely starting to form a complete picture. Identify what's important, understand the business impact, link to strategy. Now, how do they actually manage these things? That brings us to impact, risk, and opportunity management.
Exactly. This section zooms in on the actual processes and actions. How do they identify and assess material items? What policies and actions do they have to manage them? It's moving from analysis to practical implementation. Okay, from understanding to doing. And the first part looks at the disclosures on the materiality assessment process itself.
That's right. They need to describe in detail the whole process they went through to figure out what's material for them.
Show their work, basically.
Pretty much. Explain the methodologies, the assumptions, give an overview of the steps they took to identify potential impacts, considering their activities, business relationships, geography, stakeholders.
So who they talked to, what data they looked at, the logic behind deciding this matters most.
Precisely. How do they evaluate severity and likelihood of impacts? Do they consult stakeholders, maybe external experts? How do they prioritize negative impacts? Scale, scope, how fixable is it? And also outline the process for identifying and prioritizing risks and opportunities, and how those connect back to impacts and dependencies on, say, natural resources or people.
Sounds like I need to prove it was a rigorous process, not just ticking a box.
Absolutely. They also describe the internal decision-making, the controls around the assessment, how integrated it is with overall management, and if the process itself changed from last year.
Okay.
And a really crucial point here, a company only has to report on the detailed disclosure requirements in the other ESRS standards if that topic came out as material from this assessment.
So materiality is the gatekeeper for the deeper dives into specific topics like climate or water.
Exactly. It acts as a critical filter, focusing reporting effort on what truly matters for that specific company.
Okay. So once they know what's material, they explain how they manage it, starting with the minimum disclosure requirement policies.
Yes. For each material sustainability matter, they have to disclose the specific policies they have in place.
What details?
Key elements of the policy: its scope, which parts of the business, value chain, which stakeholders are affected, who's the most senior person responsible for it, any external standards it references, and importantly, how do they monitor it? Is it effective?
So not just having a policy, but showing it's alive, tracked, and someone's accountable. Then comes minimum disclosure requirement, actions and resources.
Correct. Now it's about the doing. Disclose key actions taken and resources allocated, money, people, tech, to manage those material matters.
What do they need to describe about the actions?
The actions themselves, their objectives, how they help meet policy goals or targets, the KPIs you used to see if they're working, the geographical scope, the timeline, and the specific resources committed.
So for every material issue and policy, there needs to be proof of action and investment to make it happen.
That's the idea. Demonstrable action and resources backing up the policies.
Okay. And finally, we land on metrics and targets. This is where the numbers come in, right?
Mhm.
Quantifying performance and ambition.
Yes, exactly. This section is all about providing measurable data on performance and future goals for those material sustainability matters. There's a minimum disclosure requirement metrics, which is quite straightforward. It just means companies have to disclose the specific metrics related to each material topic, as laid out in the other topic-specific ESRS standards.
So if climate change is material, they report the climate metrics from ESRS E1. If water is material, the water metrics from ESRS E3.
Exactly that. The material topics dictate which specific metrics they need to report, pulling from those other standards.
Got it. And then there's the minimum disclosure requirement targets.
Right. Here they disclose detailed info about the specific targets they've set for their material sustainability matters.
What kind of detail?
Well, first, whether and how these targets actually track the effectiveness of their policies and actions. Do the targets drive meaningful change?
Are they ambitious enough? Aligned with the challenge?
That's what you should be able to assess. The targets need to be measurable, outcome-oriented, time-bound.
Smart targets, basically.
Pretty much. For each target, describe its link to policy objectives, the target level itself, its scope, the baseline value, the time frame, any milestones, the methodologies and assumptions used to set it.
Wow, quite granular.
And importantly, is the target based on science or environmental evidence? Did stakeholders have input? They also need to disclose any changes to previous targets. And finally, report actual performance against those targets.
Including if they haven't met them or haven't set one yet.
Yes. Report progress. Explain if a target hasn't been set for a material issue. Discuss the level of ambition and any indicators they use to track how they're doing.
So setting clear goals, tracking progress transparently, and being accountable, that really does cover a huge amount of ground within just ESRS 2.
It absolutely does. ESRS 2 really is the overarching framework for these general sustainability disclosures. So you can see how the sections all link together, can't you?
Yeah, definitely.
It starts with understanding the company and its context, moves through governance and strategy, gets into systematically managing impacts, risks, opportunities.
And it's all underpinned by policies, actions, resources, and those metrics and targets.
Exactly. It all connects.
It certainly feels designed to ensure a comprehensive and, crucially, a consistent approach across Europe, which should give you, the listener, a much clearer, more standardized way to see how organizations are tackling these critical issues.
This foundational framework in ESRS 2, it really is the bedrock for all the more specific standards that follow. It does make you think, though,
Yeah.
about the practical challenges companies will face implementing this across so many different industries and sizes, and what new insights we'll actually gain as this massive shift in sustainability reporting really takes hold. Increasingly, the real nuts and bolts of running a business seem tied to sustainability. It's everywhere.
It really is. It's much more than just being green now.
Right, it's fundamental to how companies actually operate, and importantly, how they report their impact.
Exactly. And these sustainability statements, they're becoming crucial. Investors need them, consumers look at them.
Yeah, stakeholders expect much more now. Just the financial results. That's not the whole story anymore.
No, there's a real demand to understand how a company is navigating complex things like climate change and, what does that mean for its future?
Okay, so that's a perfect lead-in. Today we're going to try and pull back the curtain on a major piece of this puzzle. The European Sustainability Reporting Standards, ESRS.
And specifically, we're diving into ESRS E1. That's the one all about climate change.
Right, sort of the rule book for companies in the EU on how they need to report climate stuff.
And we've got the actual ESRS E1 document here. We've waded through it to pull out the key requirements.
Hopefully making it a bit easier to digest, cutting through some of the jargon.
That's the plan.
So our mission today, give you, the listener, a clear understanding of what's actually in ESRS E1, what really matters when companies talk climate impact.
Okay. So where do we start with such a detailed standard?
Good question. Maybe the beginning. What's its main goal, its objective?
Right. The fundamental objective of ESRS E1 is basically to make sure anyone looking at a company's sustainability report.
Investors, analysts, whoever.
Exactly. Anyone. They need to be able to understand how climate change affects that specific company.
So it's not just showing off their green initiative.
No, it's much deeper. The standard says companies have to report on their past actions and their future plans to mitigate their climate impact.
Mitigation meaning reducing their footprint.
Yes, and aligning those efforts with the Paris Agreement's 1.5-degree goal. But it's also about adaptation.
Adapting to the climate change is already happening.
Or expected changes, yes. They need to detail their adaptation plans. Plus, explain how they're managing climate risks and opportunities.
Okay. Risks and opportunities.
And crucially, how all that translates into financial effects. Short, medium, and long term.
Wow. Okay. So it really seems to cover the full picture, cutting emissions, dealing with impacts, risks, opportunities, and the money side.
It does. It explicitly covers both mitigation, cutting greenhouse gases, and adaptation, adjusting to the inevitable changes. And energy issues tied to climate are in there too.
And you mentioned this connects to other standards. It's not standalone.
Correct. ESRS E1 builds on ESRS 2, which lays out the general disclosure requirements.
So ESRS 2 is the foundation, and E1 provides the climate-specific details.
You got it. Think of it like that. You'll see E1 referencing back to ESRS 2 quite a bit.
Like our notes mention ESRS 2, GOV3, something about incentives for management. How does that fit with climate?
Good point. GOV3 requires companies to disclose if and how sustainability performance is built into incentive schemes for their management.
So they're pay packets.
Potentially, yes. In the climate context, it means saying, okay, are things like hitting emission targets or rolling out renewables, are those linked to executive compensation?
Right.
The idea is, well, it signals commitment, it puts accountability right at the top.
That makes total sense.
Yeah.
If hitting climate goals impacts the bonus pool, you can bet it gets attention.
Yeah.
Okay, let's shift to strategy. Big focus here on the transition plan. That's disclosure requirement E11.
Yes, E11 is fundamental. The core idea is that companies need to disclose their transition plan, and not just any plan.
Kind of.
It has to be a concrete strategy showing how they'll shift their business model to align with limiting warming to 1.5 degrees Celsius. It can't be vague.
So what kind of details have to be in that plan? What are they looking for?
Well, quite a lot, actually. They need to state their greenhouse gas emission reduction targets, clear numbers, clear timelines.
Okay.
They need to outline the specific actions for both mitigation, cutting emissions, and adaptation.
Right.
And describe their decarbonization levers.
Levers. What does that mean practically?
Think of them as the main tools they'll use. So investing in renewables, boosting energy efficiency, maybe changing their products or services to be lower carbon, adopting new tech, that sort of thing.
So a real roadmap for their low-carbon journey.
Exactly, step by step. And importantly, this plan can't just be, a standalone document.
It needs to be integrated.
Yes. They have to explain how it's embedded in their overall business strategy and their financial planning. Is it core to how they operate?
And does management sign off?
That's another point.
Yeah.
They have to disclose if the plan has been approved by the board or equivalent governing body. Shows top-level buy-in.
Okay, but what if a company just doesn't have one, doesn't have a plan?
The standard covers that too. If they don't have a transition plan, they must explicitly state that.
And say why.
And explain why not, which in itself tells stakeholders something important about their approach.
That seems like a very thorough requirement for the transition plan. What else comes under strategy?
There's also the link back to ESRS 2 SBM 3. This one's about the material impacts, risks, and opportunities from climate change.
And how those interact with the company's strategy and business model.
Precisely. It's about connecting the dots.
So how do they figure out what these material climate risks actually are?
The standard says they need to look at both physical risks.
Things like floods, storms, heat waves.
Exactly. The direct impacts of a changing climate. And they also need to assess transition risks.
Which are risks from the shift away from carbon, like new rules, changing markets.
Yes. New regulations, shifts in consumer demand, maybe certain technologies becoming obsolete. They need to identify which of these are genuinely significant for their business.
And once they've identified those key risks, what then?
Then they need to describe the resilience of their strategy and business model. How robust is it against these climate risks?
How do they demonstrate that?
A key tool mentioned is scenario analysis.
Scenario analysis, like exploring different futures.
Kind of. They need to consider various plausible climate futures, including ones with high emissions and significant warming, and assess how their strategy would perform.
Like a climate stress test for the business.
That's a good way to put it. It helps them understand their vulnerabilities and the robustness of their plans.
Okay, let's move to how companies actually manage all this. Impact, risk, and opportunity management. There's a general requirement from ESRS 2, IRO 1.
Yes, IRO 1 is about describing the overall process they use to identify and assess all significant sustainability impacts, risks, and opportunities.
So the how.
Right, the system they have in place. For E1, obviously, this applies specifically to the climate-related ones. It's about being systematic.
Got it. Then E1-2 gets more specific, looking at the actual policies for mitigation and adaptation.
Exactly. E1-2 asks companies to disclose the specific policies they have for climate change, policies for reducing emissions mitigation, and policies for adjusting to climate impacts adaptation.
What sort of areas should those policies cover? Any examples?
The standard points to things like energy efficiency initiatives, efforts to cut energy use overall, deploying renewable energy.
So the concrete rules and guidelines they follow.
Yes, the framework for how they intend to tackle climate change in their operations and potentially their value chain.
Makes sense. And following policies, E13 looks at actions and resources. Seems like just having a policy isn't enough.
Absolutely not. E13 demands disclosure of the key actions taken and planned. What are they actually doing to meet their policy goals and targets?
So moving from intention to action.
Right. And it's not just listing actions. It's about resources, too.
The money.
Yes. They need to disclose relevant financial figures, capital expenditure, CapEx for investments, and operating expenditure, OpEx for ongoing costs.
And explain how that money supports the climate actions.
Correct. How the spending contributes to their climate efforts, like hitting those decarbonization levers we talked about, and ultimately cutting emissions.
So what are you doing? How much are you spending? And how does it help? Good, clear. Okay, metrics and targets. E14. This feels central to tracking progress.
It really is. E14 is all about the specific targets the company sets for climate mitigation and adaptation. And critically, this includes their greenhouse gas emission reduction targets.
What specifics do they need for those emission targets?
They need to disclose targets for Scope 1, Scope 2, and Scope 3 emissions.
Just quickly, Scope 1 direct, Scope 2 purchased electricity, Scope 3 the whole value chain.
Exactly. They need to state the targets, either for each scope separately or combined, and for each target, state the base year they're measuring from and the target year they're aiming for.
But it's not just the number itself, is it? There's more context needed.
Definitely. They have to explain the target's ambition. Is it aligned with that 1.5-degree goal, for instance? What methodology did they use to set it?
Okay.
And importantly, do they plan to use carbon credits as part of meeting that target? That needs to be clear.
Any other targets besides emissions?
Yes, E14 also asks for disclosure of other climate-related targets, things like goals for renewable energy use or targets for improving energy efficiency.
So, a full picture of their climate goals and how they plan to measure success. Next up, energy consumption and mix, E15. Why pull this out specifically?
Well, for many companies, energy use is a huge driver of their emissions. So E15 demands transparency here. How much energy do they use and where does it come from?
What details are required?
Total energy consumption in megawatt hours. And that needs to be broken down by source, fossil fuels, nuclear, and renewables.
And for renewables, do they need to break that down further?
Yes. Disaggregate by type solar, wind, hydro, etc. And also specify if it was purchased energy or self-generated.
Okay.
Plus, companies in high climate impact sectors need to report this consumption separately. They also need to disclose their own energy production if they generate any non-renewable or renewable.
And energy intensity.
Right. Energy intensity, usually calculated relative to revenue. It gives a sense of their operational energy efficiency.
Got it. Now, the big one for many, gross scopes 1, 2, and 3 GHG emissions, E16. This is the core carbon footprint, right?
Absolutely. E16 is central. It requires disclosing gross Scope 1, Scope 2, and Scope 3 emissions, measured in tons of CO2 equivalent.
Giving that comprehensive view of direct and indirect impact.
Exactly. The standard points towards using the GHG Protocol corporate standard.
Why is that specific protocol important?
It's the globally recognized standard. Using it ensures consistency and comparability between companies, which is crucial. ISO standards are also referenced.
And it's not just the final number.
No, transparency is key. They also need to disclose the methodologies used for calculation, key assumptions made, and the emission factors applied. Stakeholders need to trust the data.
You mentioned specifics for each scope.
Yes, things like how emissions from joint ventures are handled. And they need to be very clear about whether carbon credits have been included or excluded in those gross figures for each scope.
And scope 3 often being the biggest chunk.
Often, yes. So for scope 3, they might need to break it down further by category, depending on what's most material for their value chain.
Okay. Then we have E17, GHG removals and mitigation projects financed by carbon credits. So this is about taking CO2 out or funding reductions elsewhere.
That's right. E17 covers these. It requires disclosure of actual greenhouse gas removals from the atmosphere and any long-term storage. Again, in tons of CO2 equivalent.
Like planting trees or carbon capture technology.
Could be, yes. Things like afforestation, soil carbon, direct air capture. And for any removals claimed, they need to explain the method and, crucially, the permanence. How long is that carbon actually stored?
And the carbon credits part.
They need to disclose the amount of emission reductions or removals that come from climate mitigation projects they funded through buying carbon credits.
What info about the credits themselves?
If they use them, they need to report the total amount, the quality standards those credits meet, this is important, and explain how these credits fit into their strategy for meeting their own reduction targets. Transparency is key here too.
Makes sense. Moving to E18, internal carbon pricing. We hear more about this now. What's the disclosure requirement?
E18 asks, does the company use internal carbon pricing? Basically putting a price on their own emissions internally.
And if they do?
If yes, they need to disclose details. What type of scheme is it? A shadow price used in calculations or an actual internal fee? What's the price per ton? What parts of the business does it apply to?
And the impact.
Crucially, yes. How does this internal price actually influence decisions, investment choices, operational changes? Does it drive lower carbon choices internally?
So making the cost of carbon visible inside the company. Okay, last big one. E19, anticipated financial effects. This really ties climate to the bottom line.
It absolutely does. E19 requires disclosing the expected financial impacts on their financial position, performance, cash flow stemming from those material climate risks, physical and transition, and also potential climate-related opportunities.
This is where the rubber meets the road financially.
Pretty much. It's about quantifying the impact.
What kind of financial effects specifically?
Things like the monetary value of assets and liabilities exposed to physical and transition risks. They need to estimate this both before and after considering their adaptation or mitigation actions.
So like the value of a factory at risk from flooding, for example.
Exactly. Or the potential hit from new carbon taxes. On the flip side, they also need to disclose potential financial upsides from climate opportunities.
Like revenue from new green product.
Precisely. Revenue from low-carbon goods or services, cost savings from efficiency. And ideally, the standard asks them to try and connect these anticipated financial effects back to specific lines in their actual financial statements.
Wow. Linking the sustainability report directly to the financials.
That's the goal, creating that clear connection.
Okay, that is incredibly comprehensive. So just to quickly wrap our heads around it, ESRS E1 covers governance, strategy, including that detailed transition plan, managing impacts, risks, opportunities, setting metrics and targets, energy use, the nitty-gritty of scopes 1, 2, and 3 emissions, carbon removals and credits, internal carbon pricing, and finally, those anticipated financial effects.
You've nailed it. It's a really thorough framework designed to give stakeholders a proper, deep understanding of a company's relationship with climate change, both its impact and how it's impacted.
Yeah, this level of transparency feels like a step change.
It's becoming absolutely essential, really, as the world tries to get to grips with climate change.
It certainly sounds like these rules will significantly shift corporate reporting and ideally drive real change in business practices. It does make you wonder, though, about the practical hurdles companies face implementing all this and what the actual real-world impact will be on that journey to a more sustainable economy.
Definitely food for thought. How this plays out in practice will be fascinating to watch. We're definitely at a point where, the environmental side of business, it's not just some optional extra anymore. It's really front and center.
Oh, absolutely. And when you talk impact, well, pollution is just massive, isn't it?
It really is.
And for any company that's serious about genuine sustainability, getting a handle on their pollution, actually doing something about it, well, it's not just responsible, it's becoming smart business,
Yeah.
especially with all the regulations coming down the line.
Yeah, which is a perfect segue into what we're tackling today. We're diving into the European Sustainability Reporting Standards, the ESRS. Specifically, we're focusing on ESRS E2. That's the one that really gets down to the details of pollution disclosure.
Right. And our aim today is, well, pretty straightforward. We want to make it clear what companies actually need to report about their pollution footprint, if they're operating in the EU or using these standards.
Sort of demystifying the new rule book for environmental accountability.
Exactly that. Think of it that way. It helps everyone understand what's expected.
And under ESRS E2, pollution isn't just one thing, is it? It covers quite a bit.
No, it's broad. We're talking air pollution, impacts on water, soil contamination, and also those tricky substances of concern that can cause real problems down the line.
Okay.
So yeah, the whole point of E2 is really to let anyone reading a company's report, could be investors, could be local communities, really grasp how that company affects pollution.
And what they're doing about it.
And what they're doing, yes. What actions they're taking now, and critically, what their plans are, their capacity to shift towards, well, the goal of a zero pollution economy.
Okay, let's jump in then. The ESRS framework starts with ESRS 2 IR01. It seems like a foundation piece for managing impacts, risks, opportunities.
Yeah.
What's the key thing here for pollution?
Well, this IR01, it's kind of an overarching requirement. It basically says companies have to describe their processes. How do they actually identify and assess what's material when it comes to their pollution impacts, risks, and opportunities?
So it's about the how.
It's all about the how, having a clear, structured method they can point to.
Right, so it's not enough to just say, we're managing pollution. They need to show they're working, essentially. What kind of detail are we looking at?
Precisely. They need to spell out if they've systematically screened their sites, their activities.
Yeah.
And this is important. Also, their whole value chain.
Upstream and downstream.
Yep. Upstream suppliers,
Okay.
downstream use and disposal, the whole lot. The idea is to find where the actual and potential pollution issues might pop up. Risks, impacts, even opportunities for improvement.
And how do they do the screening? Is it just like a checklist, or is there more expected?
No, it's definitely more than a checklist. They need to be specific about the methodologies, the tools they're using.
For example?
Could be things like detailed environmental impact assessments, maybe established risk frameworks they already use, or even specific pollution monitoring tech. The standard pushes for this transparency so stakeholders can judge if the company's assessment is actually robust,
Yeah, that makes total sense. You need to understand the method to trust the findings. What about the people actually affected? Local communities, for instance. Are their views part of this?
Yes, definitely. The requirements explicitly ask if and how the company has consulted with affected stakeholders about pollution.
So talking to people near the factory, maybe?
Exactly, or environmental groups, or whoever else might be directly impacted or have relevant concerns. Bringing those perspectives into the assessment is key.
Okay, right. So that's the assessment process. Let's move to policy. ESRS E21 is about the company's actual pollution policies. What are we looking for here?
Yeah, E21 shifts to the formal commitments. It asks companies to disclose the policies they've actually adopted to manage those material pollution impacts, risks, and opportunities they identified.
So the written rules, their internal pollution management rulebook, maybe?
That's a good way to put it. The objective is to understand, how far has the company gone in setting out clear guidelines. Do these policies cover identifying issues, assessing them, managing them, maybe even cleaning up past problems?
And these policies, they don't just float in space, right? They need to connect to the bigger picture.
Absolutely. The disclosure needs to show how these specific pollution policies fit within their overall environmental or sustainability strategy. And, importantly, how they link up with and support the big EU goal, the action plan, toward a zero pollution for air, water, and soil.
That link to the EU action plan sounds quite direct.
It is. It connects company action to those wider European environmental goals.
So the policies themselves need to be specific, too, about what kind of pollution they cover.
Exactly. They need to describe how the policies address the specific areas where the company has material impacts. Is it air, water, soil? And they need to specify which substances are covered, especially those flagged as of concern.
And ultimately, the point is that these policies actually lead to something, not just sit on a shelf.
Right. The disclosure has to explain how these policies genuinely help reduce the company's pollution footprint and how they align with any targets the company has set. It's about showing a real pathway to reduction.
Makes sense. Policies are one thing, but actions speak louder, right? So ESRS E22 is about actions and resources.
Precisely. Now we're talking about the tangible stuff. E22 asks companies to disclose the actual actions they're taking or planning to meet their policy goals and targets. And crucially, what resources they're putting behind these actions.
Resources meaning money, people.
Yeah, financial investment, personnel, technology deployment, R&D efforts. It's about seeing the real commitment. Does the talk match the walk?
Okay, so what sort of actions should companies be detailing here?
Well, we're looking for specifics. Things like pollution prevention measures, control technologies they're using, reduction initiatives, maybe including plans to phase out certain harmful substances.
What about R&D?
Yes, investments in R&D for cleaner tech.
Yeah.
And also, importantly, any efforts to restore ecosystems that might have been damaged by their pollution.
That sounds pretty comprehensive. Do they need to say where these actions are happening? Like in their own factories or with suppliers?
Yes, that's key. They need to specify the layer in the value chain own operations, upstream, downstream, where the action is mainly focused. And they also need to give a timeline for implementation. Gives a sense of progress and commitment.
And does the standard sort of categorize these actions?
It does, broadly.
Wow.
It distinguishes between actions focused on avoiding pollution in the first place, actions aimed at reducing pollution that's generated, and that includes meeting BIT requirements,
Yeah.
best available techniques,
Okay.
and then actions focused on restoring or regenerating ecosystems where pollution has already happened. So it's a kind of whole life cycle view. Avoid, reduce, restore.
Got it. Avoid, reduce, restore. Okay, let's shift to metrics and targets. ESRS E23.
This is about setting goals, right?
Exactly. E23 is all about the targets. What ambitions does the company have? How are they measuring progress? Companies need to disclose the specific pollution-related targets they've set for their material issues. So moving beyond just saying we want to pollute less to actual measurable goals.
Yes. Concrete commitments. They need to state clearly if the targets are absolutely like reducing total tons of emissions or intensity-based, say, pollution per unit of output.
And the details around that.
They need to specify the baseline year they're measuring against, the time frame for hitting the target, and critically, the KPIs, the key performance indicators they'll use to track progress. How will they know if they're on track?
And again, specific to the type of pollution. Air,
Yeah.
water.
Yep. Disclosure should specify if the targets relate to air pollutants, water emissions, soil contamination, or those substances of concern, or very high concern we mentioned. That detail is vital for understanding where the focus is and for comparing companies.
Makes sense. The standard also mentions something called ecological thresholds. What's that about in target setting?
Ah, right. Ecological thresholds are basically critical limits. If you go beyond them, an ecosystem could suffer serious, maybe even irreversible harm. So where it's relevant to their impact, companies might need to specify these thresholds. They need to explain how they make sure they stay within those limits and how responsibility for that is managed internally.
And context matters too, like legal requirements.
Yes. Definitely. They should provide context, like if a target is driven by specific laws or regulations, or maybe industry best practices. It helps understand the motivation and stringency.
Okay, now let's get to the actual pollutants. ESRS E24 requires disclosure on pollution of air, water, and soil. How granular does this get?
This is where the rubber really meets the road in terms of data. E24 is about understanding the actual types and amounts of pollutants a company's own operations release: air, water, soil. A clear, quantifiable picture of their direct impact.
So they literally have to list the pollutants and the quantities.
Pretty much, yeah. They need to disclose the amounts of each pollutant listed in Annex 2 of the EPRTR regulation, that's the European Pollutant Release and Transfer Register.
Ah, the EPRTR. So it leverages that existing system.
Exactly. It uses that established list as a baseline for consistency. Plus, they need to report other relevant greenhouse gases emitted to air, even if reported elsewhere, and any microplastics they generate or use. It builds a really detailed emissions profile.
Wow, that's a lot of data. How should it be presented so it's actually useful?
Well, the amounts should be consolidated across all the facilities the company controls operationally. And importantly, they need to show trends over time. Are emissions going up or down?
And explain how they measured it.
Yes. Explain the measurement methods, describe their data collection processes. Transparency on how they got the numbers is crucial for credibility.
And it's not just the numbers in isolation, is it? Context is important here too.
Absolutely vital. They need to provide context like local air quality, where their emissions occur, how urbanized the area is,
Okay.
and for water and soil, what percentage of their emissions happen in areas already facing water stress or risk. This helps understand the potential local impact, not just the total amount.
Any regulatory compliance stuff tied to this?
Yes. They need to list their installations covered by the Industrial Emissions Directive, IED, and any relevant EU B8T conclusions. And crucially, they must report any significant non-compliance incidents related to pollution permits or regulations.
Okay. Let's move to those specific substances. E25. Substances of concern and substances of very high concern. Sounds serious. What's required here?
It is serious. This disclosure is about transparency regarding substances that can significantly harm health or the environment. Companies need to report on their involvement producing them, using them, distributing them, trading them, both substances of concern and the even more critical substances of very high concern.
So tracking these potentially harmful materials through their whole journey with the company.
That's the idea. Understanding the extent of their involvement. This includes disclosing the total amounts they produce or procure.
Is this duplicating other reporting, like the EPRTR you mentioned?
The standard acknowledges there's overlap. Companies might already report some of this under existing laws like EPRTR, so they're encouraged to provide that relevant contextual information they already report to avoid doubling up the effort where possible.
Right. Makes sense. Finally, let's talk money. ESRS E26, anticipated financial effects from pollution. How does pollution hit the bottom line?
This is critical for investors and finance folks. E26 connects the environmental performance directly to financial performance. Companies have to disclose the expected financial effects, good and bad, from their material pollution risks and opportunities.
So putting a potential price tag on pollution.
Essentially, yes.
Yeah.
It helps stakeholders see the financial exposure, how much might pollution cost them, or, conversely, what financial benefits might come from managing it well. Quantifying this makes pollution a much more tangible business concern.
What kinds of financial effects are we talking about?
Could be operating costs, capital expenditure related to incidents or managing contaminated sites, costs for cleanup, remediation, potential compensation claims.
And the opportunity side.
Yes, also the potential positive effects. Maybe from preventing pollution, adopting cleaner tech, gaining market share with sustainable products, both sides of the coin.
So it captures costs of inaction, but also benefits of action.
Exactly. And they should provide context to descriptions of significant past incidents or contaminated sites where future costs are expected.
What if they can't put an exact number on it yet?
If a reliable monetary estimate isn't possible, they still need to provide a qualitative description. What are the likely effects? Over what kind of time frame? It still gives valuable insight even without a precise figure.
Okay. Now, briefly, before we wrap up, the framework has overall application requirements. Anything key about how companies decide if a pollution topic is material enough to report on in the first place?
Yeah, the materiality assessment is fundamental. Companies need a solid process to figure out which pollution topics are significant enough financially or in terms of impact to require disclosure.
And the standard suggests a way to do that.
It points towards the LAP approach. Locate, evaluate, assess, prepare as a kind of helpful framework for systematically working through this.
And what specific pollution areas should be considered in that assessment?
It explicitly mentions pollution of air, water, soil, covering GHGs, other emissions, waste, microplastics, those substances of concern.
Right.
And interestingly, also their dependencies on ecosystem services that help mitigate pollution like natural water purification. So it's quite holistic.
Okay, so pulling this all together, our deep dive into ESRS E2 really shows a major push for transparency on pollution, doesn't it? More than we've maybe seen before.
Oh, absolutely. It's comprehensive. From detailing management processes and policies, setting measurable targets, reporting specific pollutant data, right through to quantifying financial risks and opportunities.
Yeah.
E2 aims for a much more standardized, complete picture of corporate pollution accountability.
It's a lot for companies to get right and a lot for us to digest, but it feels really crucial for understanding a company's true environmental impact.
It really is.
Yeah.
And this level of transparency, it could be a real catalyst.
That brings us to a final thought, maybe. With all this increased transparency coming,
Yeah.
how could it actually drive innovation? Could it genuinely speed up the shift towards that zero pollution economy goal? And maybe what surprising things might we learn as companies start opening up their books, so to speak, on their pollution? Could we uncover hidden problems or maybe even unexpected solutions? Definitely something to think about. Welcome to the Deep Dive.
Great to be here.
Today, we're diving into something pretty specific but really important in the new world of European sustainability reporting.
Yeah, we've got excerpts from the ESRS E3 standard.
Exactly, the one that focuses entirely on water and marine resources.
So quite the focus.
It is, and our mission, really, for this deep dive is to unpack what these rules actually mean. What do companies need to tell us about how they interact with water, with the oceans?
And crucially, why should you, the listener, care about this level of detail?
Right. It might sound a bit niche, maybe, water resources, but it connects to almost everything. How companies manage it, well, it tells you a lot.
It really does.
Okay, so let's start at the top. What's the main objective, the sort of core idea behind this whole E3 standard?
Well, the fundamental goal of ESRS E3 is pretty straightforward, actually. It's designed to help users, like investors or the public, get a really clear picture of how a company actually impacts water and marine resources.
Okay, so not just fuzzy statements, but real impacts.
Exactly. We're talking about identifying and understanding the material impacts, both positive and negative, and whether they're happening now or could happen in the future. Real potential impacts, too.
Got it. So specifics.
Specifics. And very importantly, it also makes companies spell out the actions they're taking. What are they doing to prevent or maybe lessen the negative impacts? This covers things like, well, how much water they consume day to day, but also how they handle the risks and opportunities that pop up because of how they use water.
And when we get this kind of disclosure, this information, what does it tell us that goes beyond just, their water bill?
That's where it gets interesting. This kind of reporting helps you see how a company is actually contributing to bigger goals. Think about the European Green Deal, for instance.
Okay.
Specifically, things like supporting a healthy blue economy or protecting biodiversity. The details on water reveal their role, positive or negative, in those big picture issues. It also gives you a window into how seriously they're weaving these water and marine issues into their actual business strategy and model. Are they just ticking boxes, or are they genuinely changing how they operate?
Right. So it's impact, actions, strategy, and kind of their contribution to wider environmental health. Makes sense?
Yeah.
Now, the standard talks about water and marine resources. It sounds broad.
Yeah.
Can we pin down what that actually covers?
Good question. Yeah, needs clarification. So when E3 says water, it means both surface water, think rivers, lakes, that sort of thing, and groundwater.
Okay.
And companies need to report on their water consumption, how much they use, their withdrawals, how much they take out, and their discharges, what they put back in.
For everything they do?
For all their activities, their products, their services. It's meant to capture their entire freshwater footprint, basically.
And the marine resources part.
That's more about taking things from the sea, extraction and use. Could be fish, minerals, biomass, and also economic activities that happen in the marine environment, like shipping or maybe tourism that directly affects the oceans.
Okay, got it. And it feels like managing water isn't something that happens in a vacuum, right? The source material mentions links to other ESRS standards. How
Yeah.
connected is this?
Oh, hugely connected. Water and marine resources are like central to so many other environmental issues. The standard itself points this out.
For instance.
We'll take E1 on climate change. Physical risks from water like floods or droughts are directly covered there.
Makes sense. Climate change impacts water availability in extremes.
Absolutely. Then you've got E2 on pollution. Any pollution going into water, including those pesky microplastics, falls under that standard.
Because pollution often ends up in waterways, yeah.
Precisely. And then E4, biodiversity.
Yeah.
The health of rivers, lakes, oceans, all the life they support that's core E4 territory, directly linked to water quality and marine health.
What about resources like E5?
Good point. E5 covers resource use and circular economy. That connects too. Maybe a company is trying to use fewer non-renewable resources, which might impact water use, or reducing plastic waste that pollutes the oceans, or even recycling wastewater as part of a circular approach. It all ties back.
And it's not just environmental, is it? Water issues hit communities hard, too.
Absolutely spot on.
Yeah.
The standard explicitly says that if a company's activities related to water or marine resources have material negative impacts on local communities, that needs reporting under ESRS S3, the social standard on affected communities.
Right.
It really highlights that water isn't just some abstract resource. Managing it badly can directly harm people's access to clean water, their jobs, their health.
That interconnectedness is, well, it's clearly vital. So, okay, before a company can report on policies or targets, they first need to figure out what actually matters for them regarding water. What are their big impacts, risks, opportunities? The standard calls this the materiality assessment, using the IRO1 framework. Impacts, risks, opportunities. How does a company tackle that for something as, well, fluid as water?
Fluid. Nice one. Yeah, this materiality assessment is like the bedrock for all ESRS reporting, and for E3, it involves a pretty specific step-by-step process. The standard lays out 4 main phases they need to follow.
Okay, walk us through them. Phase 1.
Phase 1 is basically locating the interface. Sounds technical, but it just means mapping out where and how the company touches nature, specifically water and marine resources.
And not just in their own factories?
No. Definitely not. That's crucial. It has to cover their own operations and their whole value chain. Think suppliers upstream, customers downstream, even what happens to products at the end of their life.
Wow, okay. That sounds like a massive job, just mapping water use across a global supply chain.
It is a huge challenge, no doubt, especially that value chain piece. And a really critical part of this first step is pinpointing which sites theirs, or in their supply chain, are in areas at water risk.
So not just if they use water, but where they use it.
Exactly. Using water in a water-scarce region is obviously a much bigger deal. They need to flag sites in high water stress areas. The standard pushes them to think about river basins as the right scale for this, referencing things like the Water Framework Directive, because water issues are inherently local within a watershed.
So the context, the location, is just as important as the volume used.
Absolutely. Location drives the severity of impact and the type of risk. So step 1, locate. Step 2, once they know where they interact, is to evaluate the dependencies and impacts at those points.
Meaning
Understanding how they rely on water, that's the dependency part, and how their actions affect water quality or quantity, that's the impact part.
You mentioned dependencies on marine resources earlier. How do they assess something like relying on fish stocks?
Yeah, that's a good example of dependency. The standard mentions relying on things like fish, shellfish, maybe gravel from the seabed, seafood products. If your business depends heavily on wild-caught fish, you need to understand that resource is under pressure from, well, fishing, pollution, climate change, maybe destructive practices like bottom trawling. Assessing that dependency means understanding the health of that ecosystem and the human pressures on it.
Okay, so map the interactions, evaluate the reliance and impact at those spots. Then what's step 3?
Step 3 is taking all that information and assessing which impacts, risks, and opportunities are actually material, significant enough to warrant reporting and management attention, either because they significantly affect the environment or could significantly affect the company's finances or reputation.
And the final step.
Step 4 is basically reporting the outcome. They need to disclose the results of this whole process, explaining what they found to be material regarding water and marine resources.
Right, that assessment sets the stage. So once they know what's material for them, the next thing is disclosure requirement E31. Policies. What are we supposed to learn from this part?
E31 is all about understanding the company's official stance, their policies. It's about their stated intentions for managing those material water and marine issues of issues, the impacts, risks, opportunities that they identified in the assessment.
Okay, so what kinds of policies should we expect to see disclosed?
The standard gives examples like policies on how they manage water inside their operations, sourcing it, treating wastewater, preventing pollution, using it sustainably. Also, policies about designing products or services to be less water-intensive or less harmful to marine life.
Huh.
A really key one is any policy committing to reduce overall water consumption, and importantly, whether those policies specifically target reductions in those high water stress areas we talked about.
Makes sense. Prioritizing the vulnerable spots.
Exactly. And if relevant, policies about operating sustainably in oceans and seas.
So policies covering use, pollution, design, location. What should these policies ultimately aim to achieve?
Broadly, they should be aiming to contribute towards things like good water quality ecologically and chemically, protecting human health and water supplies, protecting ecosystems and biodiversity, maintaining healthy marine environments, and fundamentally minimizing those material negative impacts right across their value chain.
So when we read these, we should look for specificity, right? Not just vague commitments.
Absolutely.
Yeah.
Are they concrete? Do they sound like real plans or just nice words? That's the test.
Okay, policies are the intent. Then comes E32, which is about actions and resources. This sounds more like where the work happens?
That's exactly right. E32 is about bridging the gap between intent and reality. It requires companies to disclose the actual actions they're taking and the resources, time, money, people they're putting behind those actions to achieve their policies and hit their targets. It's the implementation plan.
What kinds of actions are we talking about here? Examples.
The standard lists things like, well, first, trying to avoid using water or marine resources altogether if possible. If not, then reducing use through efficiency measures. Also, things like reclaiming and reusing water, and even proactive stuff like restoring or regenerating aquatic ecosystems or water bodies they might have impacted.
And again, the location matters.
Yes, definitely. They specifically need to detail the actions and resources focused on those areas at water risk, including high water stress zones. The emphasis on location runs right through this standard.
It feels like a lot of these water issues, well, one company can't solve them alone, can they?
You're spot on. The standard explicitly acknowledges that. Effective management often needs collective action. Collaboration with suppliers, customers, local communities, public authorities. It's often a shared resource problem.
So they should talk about that collaboration too.
Ideally, yes. And they should also report on the financial resources being dedicated. Think capital expenditure investments in new, water-efficient tech or better infrastructure or projects aimed specifically at improving water stewardship.
Okay, so policies set the direction, actions describe the journey and the investment, and then E33 focuses on targets. What do targets bring to the table?
Targets bring the destination, the specific goals, and the accountability. E33 is about understanding the measurable goals a company has set for itself related to water and marine resources.
And these need to link back.
Absolutely. They have to support the policies and directly address those material impacts, risks, and opportunities identified earlier. Plus, companies need to explain how they track progress against these targets so you can actually see if they're getting there.
What sorts of things might they set targets for?
Could be targets for managing specific water risks or improving water quality in certain key locations, or targets for managing their use of marine resources more responsibly, maybe related to sourcing sustainable seafood, for example. A big one is likely quantitative targets for reducing water consumption overall.
And with consumption targets, again, location is key.
Yes, they need to explain how those reduction targets relate specifically to areas at water risk, especially high water stress areas. It shows they're focusing cuts where it matters most environmentally.
Should these targets just be easy wins or something more ambitious?
The guidance leans towards ambition. It mentions considering ecological thresholds when setting targets, so basing targets on what the environment can actually handle, not just what's convenient for the company. It even points to frameworks like the Science-Based Targets for Nature, SBTN.
Interesting.
And they also note targets might be necessary if a company isn't meeting the EU taxonomy's do no significant harm criteria for water. So targets can also be about fixing existing shortcomings.
Okay, that covers the strategic side. Policies, actions, targets. Now we get into the numbers with E34 on water consumption. What's the main goal here?
Right, E34 is about the hard data. It's designed to give you quantifiable information on the company's actual water consumption performance, moving from strategy to the measured reality.
What are the key metrics they have to report?
Okay, several key ones. First, their total water consumption in cubic meters, M3, just the overall volume they use. But crucially, they also have to report their total water consumption, again in cubic meters, specifically within those areas identified as being at water risk, including the high water stress ones.
That breakout is vital, isn't it? Because a cubic meter used in a very dry area has a much bigger impact.
Precisely. It gives that total consumption figure absolutely critical context. They also need to report the total volume of water they recycled and reused in M3, and the total volume they stored, plus any changes in that stored amount, also in M3.
Okay, lots of volume data. How do we compare, say, a huge company with a smaller one? Is there an intensity metric?
Yes, there is. The standard requires them to disclose water intensity. Usually this is shown as total water consumption in cubic meters per million euros of net revenue.
Okay, so that helps compare efficiency across different scales.
It helps, yeah. It provides a normalized metric for comparing water efficiency between companies or over time. But you still need to remember the context, especially where that water is being consumed. Location always matters. They also need to provide some contextual info about the water basins they operate in, quality, quantity, and explain the methods they used for their calculations.
Got it. Numbers need context. Okay, finally, let's talk money. Disclosure requirement E35, anticipated financial effects. What's this trying to show us?
This is arguably one of those challenging but also most revealing parts. E35 requires companies to translate those material, water, and marine impacts, risks, and opportunities into potential financial consequences. It's about connecting the environmental stuff directly to the bottom line.
What kind of financial effects are we talking about, both good and bad?
Both. It covers anticipated effects from the risks and dependencies they face, things like maybe rising water prices, costs from potential supply disruptions due to drought, fines for pollution, damage from floods, but also potential financial upsides from opportunities, maybe increased revenue from selling water-saving products, cost savings from water recycling, or accessing new green finance.
And over what time frame?
Short, medium, and long term.
And the really tricky part, the standard pushes for quantification in monetary terms wherever possible.
Wow, putting a euro figure on potential future water risks or opportunities sounds hard, and maybe a bit speculative.
It's definitely hard, and yes, involves assumptions. That's why it's so important that when they do provide monetary figures, maybe for the cost of needed infrastructure upgrades, or potential lost revenue from operational halts, or projected income from a new sustainable product line, they absolutely must describe how they got there.
How's it? They need to explain the financial effects, link them clearly back to the specific water-related impact or risk or opportunity, state the time horizons, and, crucially, for anyone reading the report, disclose the critical assumptions they made in their calculations.
So we can judge the numbers based on the assumptions.
Exactly. Transparency about assumptions is key here. You need to be able to see how they valued that risk or opportunity. This disclosure also connects to their regular financial reporting, where these risks or opportunities might already be impacting current performance or cash flows.
Okay, wow, we've really covered a lot there. From the basic goal of E3 through defining the scope, understanding the links to other issues, that whole materiality assessment process.
In the IRO assessment.
And then the specific disclosures on policies, actions, targets, the hard consumption numbers, and finally trying to put a financial value on it all.
It really is a comprehensive framework designed, I think, to push companies way beyond just saying water is important towards detailed, context-rich, and increasingly quantitative reporting.
What really stands out to you most about this whole approach? For me, I keep coming back to that emphasis on location, breaking out the data for water-stressed areas. It makes the numbers mean so much more.
Yeah, the location specificity is definitely a huge step forward. What strikes me is the clear attempt to connect the dots, linking environmental performance and operational data directly to high-level strategy, to governance, and ultimately trying to link it to anticipated financial results.
Right.
It forces water management out of just the environmental department silo and into core business thinking. It's not just an operational issue, it's presented as a strategic and financial one too.
Does looking at this level of detail change how you think about a company's relationship with water? It certainly makes me appreciate just how deeply tangled their operations can be with local water systems and global ones, too.
Oh, absolutely. It drives home that water isn't just some free, infinite input. It's a critical, finite, often stressed resource. A company's relationship with it is a material business issue, not just, a side topic for the sustainability report appendix.
Yeah.
The disclosures here are really designed to let you assess not just how they've used water in the past, but how resilient they might be to future water challenges and what their ongoing impact is likely to be.
That makes sense. I guess the big question hanging in the air then is, with all this incredibly detailed reporting, How quickly will it actually translate into real positive changes for our rivers, our groundwater, our oceans?
That's the million-dollar question, isn't it?
Disclosure is vital, that first step, but the ultimate goal has to be tangible improvements on the ground. Something for us all to watch, I suppose, as this reporting rolls out. Definitely something to think about as we wrap up this deep dive.
Indeed. Lots to consider.
We often talk about the big numbers in business, the big challenges, but today we're plunging into a really crucial space where they meet head on.
Yeah, it's about how companies actually measure and report their impact on the living world. The whole biodiversity and ecosystems piece.
Exactly. We're talking specifically about reporting on biodiversity and ecosystems.
And for this deep dive, our source material is, well, it's a really detailed look into one specific set of disclosure requirements. ESRS E4, European Sustainability Reporting Standard E4.
Right, part of that big EU push for transparency.
Exactly.
So our mission really is to take the standard, ESRS E4, which can look pretty dense, and unpack it a bit. What are companies actually being asked to tell us about, their relationship with nature?
And crucially, why does it matter to you if you're trying to understand the real footprint of a business?
Because this isn't just like abstract environmental rules, is it?
Not at all. It's a framework that's really designed to make businesses face up to their actual physical impact, positive and negative, now and in the future.
On the whole web of life.
Yeah, impacts on species, on habitats, entire ecosystems, and importantly, it also explicitly includes impacts on indigenous peoples and local communities, those whose lives are often deeply connected to nature.
Okay, so let's get into the standard then, ESRS E4. What's the main goal? What are they trying to achieve with this?
Well, the core objective is pretty straightforward, actually. It's to give users of a company's report, think investors, customers, regulators, you listening, a clear picture.
A clear picture of how that company affects biodiversity and ecosystems.
Exactly. And that means looking at all their material impacts, dependencies, risks, and opportunities connected to nature.
Material being the key word there, stuff that's actually significant, either to the business or to the environment.
Precisely. And the scope, well, it's huge. It covers land, freshwater, marine environments, everything.
And it's not just about the direct harm they might cause.
No, that's a critical point. It also requires them to disclose how they contribute to those bigger, wider trends of biodiversity loss and ecosystem degradation.
And it's not just looking backward, right? It's forward-looking, too.
Absolutely crucial. They need to talk about the actions they are taking now, sure, but also their plans. How are they going to adapt their whole strategy, their business model, based on understanding these nature impacts and dependencies?
Which brings us to the money side.
Yep. The standard makes them report on the anticipated financial effects, the risks and the opportunities that come from this whole relationship with nature.
What's really striking here is how this standard forces that connection. Business model meets, well, the health of the planet.
Right. Biodiversity loss, ecosystem degradation. They're not these distant environmental issues anymore. The standard frames them as creating very real material risks and opportunities for businesses.
Like what kind of things?
Oh, everything from, say, supply chain disruption because a key resource disappears, to maybe new market opportunities in ecological restoration.
Makes sense. And our source material points out how integrated this is. It links up with other reporting areas.
Yeah, connects directly to disclosures on climate change, obviously, but also pollution, water use, resource use, the circular economy stuff.
And then the social impacts, too. You mentioned affected communities.
Yes, that link is really strong. Often, these are the people who depend most directly on local biodiversity, local ecosystems for their livelihoods, their culture. Their well-being is tied up in this.
And this isn't just happening in isolation, is it? It connects to bigger global targets.
Exactly. The standard explicitly references alignment with major international agreements, like the Kunming-Montreal Global Biodiversity Framework.
The big one from COP15.
That's the one. And also regional ones like the EU Biodiversity Strategy for 2030. And it grounds itself in science, referencing things like planetary boundaries.
Planetary boundaries like biosphere integrity, land system change, these big ecological limits.
Right. It's about getting companies to recognize formally that business operates within these natural limits.
Okay, let's dive into the actual core areas then. What do companies have to report on? Starting with strategy, ESRS E41, I think it is?
Yep, E41. And ESRS just stands for European Sustainability Reporting Standards, for anyone keeping track. This section asks companies about their transition plan for biodiversity and ecosystems.
So how nature fits into their big picture strategy and their business model.
Yes, exactly. They need to show how they're adapting their fundamental way of doing business based on the impacts, dependencies, risks, and opportunities they've figured out.
And here's where it gets really, really interesting. They have to talk about the resilience of that strategy.
Can their business model actually cope if nature keeps degrading? Or if policies suddenly get much stricter? It's a tough question.
Thinking about those physical risks, maybe, like extreme weather hitting your facilities because nearby forests that offered protection are gone.
As a classic physical risk, yeah. Or transition risks, new regulations popping up, consumers suddenly boycotting products linked to deforestation, that sort of thing. Reputational damage.
And this strategy section is where they explain how their plan helps meet those global biodiversity goals and respects those planetary boundaries we mentioned.
Precisely. It's showing they have a credible plan to align their business with, well, a nature-positive future, ideally.
Okay, so how do they even begin to figure out what their material impacts, dependencies, risks, and opportunities are? That sounds like a massive task.
It is. And that links to another core part of the standards, ESRS 2, IRO 1. Impact, risk, and opportunity management.
Right, IR1, that's where they explain their process, isn't it? How they actually do the homework to identify and assess what's material.
Exactly. And they need to think across different timescales,
Yeah.
short, medium, long term. What matters next year versus what matters in, say, 20 years.
And our source mentions specific types of risks they need to hunt for.
Yeah, it breaks them down. You've got the physical risks, like we mentioned, supply chains disrupted by floods, droughts made worse by land degradation.
Okay.
Then transition risks, policy shifts, market changes, maybe technology shift towards nature-friendly alternative or reputational hits. And critically, it also mentions systemic risks, like the cascading consequences. If a major ecosystem, maybe a vital fishery or a rainforest, actually collapses, the ripple effects.
Wow. And you mentioned dependencies before, that businesses actually rely on nature.
Absolutely fundamental. Think about any company using timber or cotton or relying on clean water or even insect pollination for its agricultural inputs. Those are direct dependencies on ecosystem services.
So if those services decline.
Their business model is directly under threat. Simple as that.
And a key part of identifying all this is talking to people, right? Consultation.
Yes, very important. Engaging with affected communities, suppliers, scientists, NGOs. They often have crucial on-the-ground knowledge about impacts and dependencies that a company might miss from its headquarters.
And companies might even need to do scenario analysis, like what-if exercises.
Yeah, disclose biodiversity and ecosystem scenario analysis. Testing how different future states of nature or different policy pathways could affect their business. Stress testing their strategy, essentially.
Okay, moving on. Policies. ESRS E42 requires them to disclose the policies they've actually adopted related to biodiversity and ecosystems.
Right. This is about the rules and principles they set internally to guide their actions.
And these policies should directly tackle how they plan to manage those material impacts, risks, dependencies, opportunities they found in the previous step.
Exactly. Connecting the dots.
And there's a really fundamental principle highlighted here, the mitigation hierarchy.
Yes. This is absolutely central. You'll see it referenced again and again. The policies must prioritize avoidance of negative impacts first and foremost. Don't cause the harm in the first place.
Avoidance first.
Then, if you absolutely can't avoid it, you minimize the impact as much as possible.
Okay.
Only after you've done everything to avoid and minimize do you look at restoring any damage caused.
Restoration comes third.
And right at the bottom, as a last resort, comes offsetting unavoidable residual impacts, buying credits or funding protection elsewhere.
So it's a clear cascade: avoid, minimize, restore, offset, AOMR.
Precisely. Avoid first, offset last. That hierarchy is key.
Because trying to fix or offset damage later is often way harder, more expensive, or sometimes just impossible compared to preventing it initially.
Exactly right. And the standard says these policies should, ideally, be based on good science and involve stakeholder input where it makes sense.
They can also cover other things, like traceability.
Yeah, ensuring they know where their materials come from, especially high-risk commodities, and also considering the social consequences of their activities on biodiversity and ecosystems. It's all linked.
Okay, policies are great, but you need action. ESRS E43 is about putting the rubber on the road, right? The actual actions and the resources.
Spot on. This section is where they disclose the concrete steps they're taking to implement those policies. What are they doing?
And again, structured around that mitigation hierarchy.
Yes. What specific actions are they taking to avoid impacts, to minimize them, to restore ecosystems, or, as a last resort, to offset? They need to detail that.
And measure success, KPIs.
Yeah. Key performance indicators for these actions.
Yeah.
And crucially, the financial side, the costs, the investments involved in these actions. How are they resourcing this?
And it calls out actions in sensitive areas specifically.
Yes, disclosures are particularly important for actions taken in biodiversity-sensitive areas, hotspots, protected areas, places critical for ecosystem services.
And they also need to explain how their actions might contribute to, like, wider system change, not just fixing their own little patch.
Right. How does what they're doing contribute to broader positive outcomes for nature? It encourages thinking beyond just compliance.
So policies, actions, how do they track if any of this is actually working, moving towards a nature-positive goal? That brings us to targets and metrics, E44 and E45.
Exactly. Companies need to disclose their specific, measurable targets related to biodiversity and ecosystems.
Targets that should link back to their policies and actions.
Yes, and ideally contribute to those bigger global and EU goals we talked about earlier. You could even have targets based on the mitigation hierarchy.
Like a target to avoid development in X% of high biodiversity value areas.
Precisely. Or a target for restoring a certain area of degraded land.
Okay, so those are the targets. And metrics are how they measure progress towards those targets.
Yep. ESRS E4 asks for specific impact metrics. The source gives quite a few examples.
Yeah, give us a few, maybe make them a bit more concrete.
Sure. Things like changes in land cover over time. So measuring hectares of deforestation linked to their supply chain, or maybe land converted for mining, versus hectares they've helped restore.
Okay, land cover. What else?
Changes in how ecosystems are managed, like tracking the percentage of agricultural land under sustainable practices, or forestry areas certified to certain standards.
Management practices, got it.
Also, changes in spatial configuration, fancy term, but it basically means how habitats are connected or broken up. So measuring habitat fragmentation caused by, say, a new pipeline, or maybe metrics on efforts to create wildlife corridors.
Like that road cutting through a forest example. Makes it harder for animals.
Exactly. Then there are metrics on impact drivers, like tracking the spread of invasive alien species if their operations might be contributing to that. And metrics on threatened species themselves. Are populations going up or down? Is the extinction risk changing for species in areas they impact?
And just general species diversity, like counting species.
Yeah, broader measures like species richness, how many different types or abundance, how many individuals in the areas they affect, though, as you can imagine.
Measuring species diversity across a global company's footprint sounds incredibly complex.
It really is. Which is why the standard stresses focusing metrics on the material impacts, especially in those sensitive areas. And transparency is key.
Transparency about how they measure.
Exactly. What methods did they use? Was the data primary stuff they collected themselves, secondary from external sources, or was it based on modeling? They need to disclose that.
Okay, nearly there. Last big piece, the money again. ESRS E46, anticipated financial effects.
Right. This looks back to the beginning. Companies have to disclose the expected financial impacts, positive and negative, short, medium, long term, that they anticipate could arise from those material nature-related risks and opportunities they identify.
And this needs to connect directly to their actual financial statements. Position, performance, cash flows.
That's the goal. Make that link explicit. The standard pushes for quantified financial information if possible. Put a number on it.
But acknowledges that might be hard.
Yeah, it allows for qualitative information if quantification isn't feasible or perhaps material at this stage. But the intent is clear. Connect nature to the financial health of the company.
Okay, wow. So let's try and bring this all together for you listening. We've taken quite a deep dive into ESRS E4.
We look at its core goal, transparency on nature impacts, its broad scope, land, water, communities, and the key reporting pillars it sets up.
Right. How companies weave nature into their strategy.
How they identify and manage impacts, risks, and opportunities.
The policies they set, guided by that crucial mitigation hierarchy.
The concrete actions they take and resources they commit.
The targets and metrics they use to track progress.
And finally, the bottom line, the anticipated financial implications.
So why should you care about all these, frankly, quite detailed requirements?
Because they give you a framework. Knowing these categories means you can look at a company's sustainability report when these ESRS reports start coming out and understand what they should be telling you.
It helps you see where they're focusing, maybe where the gaps are.
Exactly. It gives you a lens to evaluate how seriously they're taking their relationship with nature. It empowers you, really, to ask more informed, specific questions about their impact.
So the key takeaway from this deep dive, ESRS E4 is a pretty significant step, wouldn't you say?
I think so. It pushes companies way beyond just vague green statements. It forces a structured, comprehensive way of thinking about their interaction with biodiversity and ecosystems.
And crucially, it links environmental impact directly to core business stuff, strategy, risk, finance.
It really tries to make nature a material business issue, hardwiring it into corporate reporting. That's the aim.
Which leaves us with maybe a final provocative thought for you to mull over.
Oh, boy.
Given how incredibly complex it is to measure something as dynamic, as intricate as biodiversity and the health of countless different ecosystems all over the world,
Yeah.
how much can even a detailed standard like ESRS E4 truly capture the full nuance, the deep interconnectedness, and the real urgency of nature loss?
That's the big question, isn't it?
And will these disclosures, however detailed we make them, actually be enough on their own to drive the kind of massive transformative action that science tells us is needed to reverse these trends? Or is it just one piece of a much larger puzzle? Welcome to the Deep Dive.
Great to be here. And our mission today, well, it's straightforward. We jump into the sources, pull out the key stuff just for you.
Exactly. And today we're tackling something really fundamental, I think, for understanding how companies interact with the planet. That's ESRS E5.
That's the one. Resource use and circular economy. And our source today is, well, it's the standard itself, an excerpt from ESRS E5.
Right. So the goal for this deep dive is really to unpack it. What's the objective? What do companies actually have to disclose?
And maybe most importantly, why does this matter? Why is this key information for anyone trying to gauge a company's, sustainability efforts or even its future resilience?
Okay, so get ready to get into the details.
Yeah.
How companies manage resources, what comes in, what goes out, how they handle waste, keeping materials circulating. Let's dive in.
Let's do it.
Okay, so let's start unpacking this. The main objective of ESRS E5. It seems pretty clear from the text, right?
It is. It's designed specifically to lay out these disclosure requirements, things companies have to report.
And the point is to help users. That could be investors, customers, anyone interested, really understand how a company's actions affect resource use and the circular economy.
Precisely. It's about getting transparency. So users can really grasp specific things like, how does the company impact resource use? Is it positive, negative?
Right. Thinking about things like efficiency, or are they depleting resources? Are they sourcing sustainably? That kind of thing.
Exactly that. And it's not just about describing impacts.
No, they have to talk about what they're actually doing, right?
Yes. The standard requires them to disclose the actions they're taking, concrete steps to prevent or lessen negative impacts.
And also actions that help decouple economic growth from just using more and more resources.
That's a key phrase, decoupling. That's exactly what it pushes for, breaking that link between growth and resource consumption.
That's the big challenge, isn't it? What else does it push companies to reveal?
Well, it also wants disclosure on their plans. And importantly, their capacity to adapt their strategy, their whole business model, using circular economy ideas.
So how are they planning to keep materials valuable for longer? Use things more efficiently?
That's it, digging into the actual strategy. And crucially, connecting it to business reality.
Ah, the risks and opportunities piece.
Yes. A really critical part is understanding the material risks and opportunities. The significant ones that come from resource use and circularity issues.
How are they managing those? And what are the financial effects?
Exactly. Short, medium, and long-term financial effects. That's vital for assessing, well, the company's future prospects, its viability.
Okay, so it's really a full picture. Impacts, actions, plans, risks, opportunities, and the potential hit or boost to the finances. That's quite comprehensive.
It aims to be.
So what specific areas of resource use and circular economy does E5 focus on for these disclosures?
It drills down into three main areas for reporting. First, resource inflows, basically what's coming into the company.
Materials, resources.
Yep. And looking at how circular those inflows are. Are they using recycled stuff? Are they relying on renewables or non-renewable?
Okay, inflows. What's second?
Second, resource outflows. So information about the products and materials leaving the company's operations.
Then third.
Third is waste. It's treated as a really specific, significant type of outflow that needs its own focus.
Inflows, outflows, waste.
Got it. A clear operational structure. Now, this idea of the circular economy, the source defines it. Right. And it sounds like more than just, recycling bins.
Oh, definitely. It defines it as an economic system where the goal is to maintain the value of products, materials, resources for as long as humanly possible.
Maintaining value. Okay.
Yeah. And the ultimate aim is to minimize waste, drastically enhance efficiency, both in making things and using things, production and consumption.
And it mentions the waste hierarchy. That sounds familiar.
It does. It explicitly says to apply the waste hierarchy throughout the life cycle to maximize value. It's that classic pyramid, prevention first. Right. Reduce, reuse, recycle, but maybe more formally defined.
Exactly. Prevention is top. Then preparing for reuse, then recycling, then other recovery like energy from waste, and only then disposal as the very last resort.
And the standard links this to specific concepts.
It does. Things like designing for durability, making things last, optimal use, reuse, refurbishment, remanufacturing, recycling, even nutrient cycling for biological stuff.
So keeping things in use at their highest possible value for longer.
That's the core idea.
And this isn't just pulled out of thin air for ESRS, is it? It builds on existing EU stuff.
That's right. It's grounded in things like the EU Circular Economy Action Plan, the Waste Framework Directive. It's reinforcing that shift away from the old linear model.
The take-make-waste model.
Exactly. Moving away from that requires companies to really look at resource use and circularity across their whole value chain.
Okay. Now, it seems pretty obvious that how a company uses resources would affect other environmental areas.
Absolutely. Resource use is, well, it's a massive driver for other major impacts. Climate change is the big one.
How so?
Well, extracting resources, processing them, transporting them, it all takes energy, often leading to greenhouse gas emissions. So it links directly to ESRS E1 climate change.
Makes sense. And pollution, too, I imagine.
Definitely. ESRS E2 pollution. Manufacturing processes, emissions, substances of concern used or generated, and of course waste disposal itself is a huge pollution issue.
Water.
Yep. ESRS E3, water and marine resources. Resource extraction often needs a lot of water, and waste can pollute waterways.
And biodiversity, the impact of sourcing materials.
Crucial link there to ESRS E4 biodiversity and ecosystems. Getting raw materials directly impacts habitats and species. Land use change from mining or logging, for example.
And the standard also flags a social link, doesn't it, with communities?
It does. It points out that resource use impacts, especially around waste, can really affect people and communities. So there's a connection to ESRS S3 affected communities.
Right. Environmental and social issues often overlap. And of course, E5 sits alongside the general standards, ESRS 1 and 2.
Exactly. Those set the overall framework, the general principles and disclosures that apply to all the specific topics like this one.
Okay, so ESRS 1 and 2 lay that groundwork. Now, let's get into the nitty-gritty of E5. The first big disclosure requirement, IR1. Identifying and assessing impacts, risks, and opportunities. Sounds foundational.
It really is. It's asking companies, describe your process. How do you figure out which resource use and circular economy issues are actually significant for your business?
And how much detail do they need on that process?
Quite a bit. They need to explain how they screen their operations, their assets, how they assess potential impacts, risks, opportunities, not just inside their company, but upstream, downstream, the whole value chain.
So suppliers, customers, end of life.
The whole life cycle.
Yeah.
They need to talk about the methods they use if they consulted communities.
And this builds on the general materiality assessment from ESRS 2.
It does. It takes that broader assessment and focuses it specifically through the lens of resource use and circularity. What's material here?
Can you give us some examples? What kind of risks and opportunities are we talking about?
Sure. Risks could be transition risks, maybe new laws banning certain materials or new tech making old ways obsolete. Physical risks, too, like critical resources just running out.
And opportunities.
Opportunities like, well, saving money through resource efficiency, finding new markets for circular products, maybe getting green finance, green bonds, building more resilient supply chains, enhancing reputation.
Okay, so identifying the issues is step one. Then what? How do they report on managing them?
Right. That leads straight into disclosure requirement E51. Policies. Companies have to disclose the policies they've actually adopted to manage those material impacts, risks, and opportunities they just identified.
And the goal here is for users to see what?
To understand the company's formal stance. What are their policies for assessment, for management, for fixing things, remediation? What's their official approach?
What should these policies cover? Any specifics mentioned?
Yes. The source points to key things like policies addressing the shift away from virgin resources,
Right.
policies on increasing the use of recycled or secondary materials,
Okay.
and policies on sustainable sourcing if they use renewable resources, maybe mentioning things like cascading use for biomass. And critically, these policies need to cover the value chain.
Not just their own operations.
Absolutely not. Impacts and risks often lie upstream or downstream.
And specifically on circular economy stuff like the waste hierarchy.
Yeah, the guidance suggests these should be part of broader sustainability policies and should definitely address how the company tackles that waste hierarchy prevention, reuse, recycling, and so on.
Okay, so policies set the direction.
Mhm.
Then comes disclosure requirement E52. Actions and resources,
Mhm.
turning policy into practice.
Exactly that. Now you have to disclose the specific actions you're taking and the resources, money, people, tech you're putting behind implementing those policies.
The objective being.
To let users see the concrete steps. What investments is the company actually making to hit its policy goals and any targets it set? Show us the action.
What kind of actions are we talking about? Give us some examples.
Okay, so the source lists things like actions to boost resource efficiency inside the company, actions to actively use more secondary raw materials recycled stuff,
Right.
applying circular design to products, designing for durability, making things repairable, making them recyclable at the end.
Literally changing how products are designed and made.
Yes. And also adopting circular business models, things like offering maintenance and repair services, setting up refurbishment programs, supporting upcycling or recycling schemes, maybe extended producer responsibility.
Industrial symbiosis, too, where one company's waste is another's input.
That's mentioned too. Plus, specific actions to prevent waste happening in the first place all along the value chain, and actions to manage the waste that is created according to that hierarchy.
Reducing waste generation and managing what's left better. And the source notes this might involve working with others. Collaboration.
Often essential. Effective action frequently needs partners, suppliers, customers, other businesses, communities, government bodies. Companies should talk about these collective efforts if they're happening.
Okay. Policies, actions, leads logically to goals. Disclosure requirement, E53. Targets.
Yep. Companies have to disclose the specific, measurable targets they've set related to resource use and circular economy.
And reporting these targets lets users
Understand the company's ambition. What are they actually aiming for regarding their material issues? Targets give you something concrete to track progress against over time.
What kind of areas might targets cover?
The source mentions targets on, say, increasing durability or repairability scores for products, increasing the percentage of circular materials used, minimizing virgin material use, setting goals for sustainable sourcing of renewables, maybe linked to efficiency principles like cascading use.
And waste targets, obviously.
Big time. Waste management targets, specifically linked to the levels of the waste hierarchy, how much waste prevented, how much reused, how much recycled, etc.
Can these targets be linked to, like, planetary boundaries or scientific limits?
Yes, the standard explicitly notes targets can be set based on ecological thresholds, which is quite ambitious, and it clarifies they need to report both legally mandatory targets and any voluntary ones they've set for themselves.
Okay, so that covers the company's strategy. Policies, actions, targets. Now let's get into the actual material flows. Disclosure requirement E54. Resource inflows. What's coming in?
Right. Companies need to disclose specific data on the resources flowing into their operations, especially focusing on those linked to the material impacts, risks, and opportunities identified earlier.
And the aim here is to give users a clear view of what the company uses, both in its own operations and upstream.
Exactly. The disclosure needs to describe the key inflows by material type. Could be raw materials, components, packaging.
Even things like water or big equipment.
Yes, water use, major items of property, plant, and equipment if they're significant in resource terms, like big machinery, buildings.
And what about the numbers? What quantitative data?
Key things are the total weight of products and materials coming in, the percentage of that total that's used for non-energy purposes, so the actual physical stuff,
Okay.
and crucially, the weight or percentage of those inflows that are secondary, meaning they come from reused or recycled sources.
Ah, so you can see how much recycled or reused material they're actually using as input.
Precisely. It's a direct measure of circularity on the input side. They also need to explain their calculation methods and assumptions, which is vital for data reliability.
And this could cover lots of categories.
Yeah, raw materials, textiles, electronics, packaging, construction materials, vehicle components, depends on the business. And transparency on sources, like if it's a byproduct from somewhere else, is also encouraged.
Okay, that's inflows. Logically, next is disclosure requirement E55, resource outflows. What's going out?
Right. Disclosing information on resources leaving their operations. The objective here is to help you understand how the company's outputs its products, its waste, contribute to, or maybe hinder, the circular economy.
How do they show that? What do they report?
Well, outflows include the products they sell and any other materials leaving the process. For products, they need to describe characteristics relevant to circularity, things like expected durability.
How long it's meant to last?
Yeah. Information on reparability rates, if they have them from ratings or internal data, and the rates of recyclable content within the products and their packaging.
So does it last? Can you fix it? Can it be recycled? Key questions.
Those are exactly the kinds of insights this disclosure aims to provide on the product side.
And waste is a big part of outflows, you said.
A very specific and significant part. Companies have to report the total amount of waste they generated, usually in tons or kilograms. And this needs breaking down.
How so?
Broken down by hazardous versus non-hazardous waste. And then broken down by what happens to it. Does it go to recovery operations like preparation for reuse, recycling, maybe energy recovery, or does it go to disposal incineration without recovery, landfill, other disposal methods?
So you see where it all ends up.
You do. And crucially, they must also disclose the total amount and the percentage of their waste that was not recycled.
That paints a pretty stark picture of their waste footprint and management effectiveness.
It's meant to. Companies should also specify waste streams relevant to their sector: mining tailings, e-waste, food waste, construction debris, whatever applies. Details on hazardous and radioactive waste are also required if relevant.
And again, methods and assumptions needed for the data. This primarily covers waste they generate themselves, right? Not customer waste.
Generally, yes. It focuses on the pre-consumer waste they generate and manage in their own activities, unless they have specific downstream responsibilities like through take-back schemes.
Okay, so we've got inflows, outflows, products, waste, finally connecting it all back to the money, disclosure requirement, E56, anticipated financial effects.
The final piece of the puzzle. Disclosing how those material risks and opportunities around resource use and circularity are expected to hit the company's finances.
And the objective is clear. Help users understand the potential impact on the company's financial position, performance, cash flows over time.
Over time, exactly. Short, medium, and long term. Where they can, they should quantify these effects in money terms.
And if they can't put a precise number on it,
then they need to provide a solid description of the expected effects. What are the impacts? Are they dependent on certain things happening? What are the time horizons? And very important, what critical assumptions did they make in this assessment?
disclosing assumptions seems absolutely key for interpreting financial forecasts like this.
It's essential. It provides context and allows users to judge the reliability. It forces companies to really think through the financial side of resource scarcity, new regulations, or the potential upside from circular business models.
Wow. Okay, so putting this all together, what's the big picture takeaway from ESRS E5?
Well, it gives us a really detailed, quite rigorous map for how companies have to report on their whole relationship with resources. It's far beyond just saying we recycle.
Yeah, it's not just consumption. It's strategy, policies, actions, targets.
Backed up by actual data on inflows, outflows, product characteristics, waste streams, waste management methods.
And connecting all of that directly to potential financial impacts.
Wow.
Risks and opportunities made tangible.
It really is a comprehensive framework. It pushes companies way past vague sustainability talk and demands specifics. Specific data, specific processes linked to strategy, linked to finance. For users like you, it offers a level of transparency on circularity efforts that just wasn't consistently available before.
This deep dive really highlights how detailed and demanding sustainability reporting is becoming under ESRS. It's a major shift towards accountability.
Agreed. It gives us the information needed to assess actual performance and plans, not just nice-sounding intentions about resource use.
So here's something for you, the listener, to think about. As you start seeing reports based on standards like this, how might this level of transparency, specific data on recycled content, on repairability, on exactly where waste goes, how might that change the way you look at companies? Does knowing these specific requirements exist make you view corporate sustainability claims differently? Maybe with a more critical eye, looking for that concrete proof.
Something to definitely consider as these disclosures become more common.
Welcome back to the Deep Dive. Today, we're tackling something really fundamental to understanding any company: their actual conduct.
Mhm.
We're sort of pushing past the numbers on the balance sheet to look at ethics, their relationships with crucial partners like suppliers, and even, how they engage in the political arena.
That's right. And our source material for this deep dive comes from excerpts of the ESRS G1 standard. This is the European Sustainability Reporting Standard that, well, it zeroes in specifically on business conduct.
Okay, so the mission. Really unpack what G1 requires. Because these standards aren't just for show, right?
Not at all. They're designed so when you're using a company's sustainability report, can get a clear picture of their strategy, their approach, their actual processes, and yeah, how they perform on these core conduct matters.
We want to highlight the most important, maybe even surprising things companies now have to tell us about, well, how they behave.
Okay, let's jump in then. The fundamental objective of ESRS G1, as the standard lays it out, is really to give users the ability to understand an undertaking's approach and performance when it comes to business conduct.
Right.
Think of it as kind of lifting the lid on the how behind the business.
So what specific parts of business conduct does this standard demand transparency on? Because, that phrase can cover a lot of ground.
It structures it into three key pillars.
Yeah.
First, they look at the company's business ethics and overall corporate culture.
Okay.
And this gets quite specific, including things like anti-corruption and anti-bribery efforts, how they protect whistleblowers, and interestingly, it even covers animal welfare.
Wait, animal welfare under business conduct. That feels surprisingly broad for this standard. What's the thinking there?
Well, it signals that the standard setters view a company's ethical footprint as extending beyond just human interactions, to how they treat animals in their operations or supply chain as part of a broader ethical stance, essentially. The second pillar is the management of relationships with suppliers. And a really pointed focus here is on payment practices, specifically preventing late payments, particularly to small and medium-sized undertakings, SMEs.
That specific call-out for SMEs really highlights the practical, sort of real-world impact this reporting aims for, doesn't it?
Exactly. It acknowledges that payment terms can be, well, existential for smaller businesses.
Hmm.
The third pillar, then, is activities related to exerting political influence, including lobbying.
So they have to talk about their ethics internally, how they treat suppliers, and how they engage externally in the political sphere. It covers quite the spectrum.
It really does.
The sources also make it clear this G1 standard isn't a standalone document, right? You don't just read this one piece.
Crucially, no. It's part of a suite. You absolutely need to read it alongside the foundational standards. ESRS 1, which covers the general principles of reporting, and ESRS 2, which sets out general requirements applicable to all topics.
And ESRS 2 links directly to what G1 is asking for.
Absolutely. Especially the sections in ESRS 2 on governance, that's GOV, Strategy SBM PAN, and how the company manages impacts, risks, and opportunities, or IROs as they call them.
Right.
For instance, ESRS 2 GOV 1 requires companies to disclose a role and, importantly, the specific expertise of their leadership bodies, like the board, when it comes to overseeing business conduct matters.
So who at the top is responsible for ensuring good conduct, and are they actually qualified to do that? That's a key piece of governance transparency.
Precisely. And ESRS 2 IRO 1 requires them to disclose how they even decide which business conduct issues are material or, important enough to report on in the first place. What criteria are they using?
Like a location or sector.
Exactly. Is it based on the location of their operations, the sector they're in, maybe the specific type of transaction? Understanding their process for identifying problems is, well, fundamental.
Yeah, you can't report on what you haven't identified as important. That makes total sense. Okay, let's get into the specifics of what they actually have to reveal, starting with their policies and corporate culture. What does the standard demand here?
Okay, diving into that first pillar.
Yeah.
This is all under what's outlined in the sources around policies and culture, G11. The core idea is that companies must disclose their key business conduct policies and explain how they foster their overall corporate culture.
Okay.
The goal is to show users how these policies help them identify, assess, manage, and fix problems related to material business conduct IROs.
What kind of detail are they expected to provide about these policies? Is it just like a link to a PDF somewhere?
No, it's more than that. They need to describe the actual mechanisms they have, how people can identify, report, and investigate concerns about wrongdoing or behavior that breaks their codes.
Right.
And importantly, they have to state if external stakeholders, like suppliers, customers, community members, can also use these reporting channels.
So transparency on who can blow the whistle, essentially.
Exactly. And here's where the standard gets really pointed. It requires companies to explicitly state if they do not have anti-corruption or anti-bribery policies that align with the UN Convention Against Corruption.
Wow.
And if they lack them, they then have to disclose if they plan to implement them and provide a timetable.
Wow. So admitting a gap in policy is itself a mandatory disclosure.
Yeah.
That's a different level of transparency than just reporting on what you do have.
It forces companies to acknowledge where they might be falling short, doesn't it?
Yeah.
The same applies to whistleblower protection policies. If they don't have them, they must say so and outline their plans and timeline for implementation. And they should reference how they align with relevant laws like the EU Whistleblower Directive.
And how they actually protect them.
Yes, they need to detail how they protect whistleblowers, describing internal channels, how they inform and train workers on using them, training for the staff who actually receive the reports, and the specific measures they take to protect against retaliation, in line with the law.
What about incidents that don't come through a specific whistleblower channel, just general issues?
Good point. They must disclose if they have procedures to investigate business conduct incidents generally, including corruption and bribery, ensuring these investigations are prompt, independent, and objective, even if not initiated by a whistleblower.
Okay.
And circling back to that earlier point, if relevant to their operations, they must disclose their policies regarding animal welfare.
It keeps coming back to that.
It does. Other key policy details required include their approach to business conduct training, who gets trained, how often, how in-depth it is, and identifying which specific functions within the company they've assessed as being most at risk of corruption and bribery.
That makes sense. Target the risk areas. The sources also mention some optional disclosures about how they foster the culture of ethics, not just the policies.
Right. Appendix A suggests companies may choose to discuss aspects of their culture. This could include things like what ethics-related topics the leadership bodies discuss and how frequently, the main themes they're promoting culturally, how leadership provides direction on conduct, or maybe how employee incentives might be linked to fostering an ethical culture.
Okay.
It has a layer of qualitative insight beyond just the formal policies, you see.
Yeah, definitely. Okay, shifting gears slightly, let's look at how they manage those crucial supplier relationships. What does G1 require here? G1 2.
That's it, G12. This section focuses on how companies manage their relationships with suppliers and the broader impacts within their supply chain. The objective is really transparency about their procurement process and, specifically, how they ensure fair behavior towards suppliers.
And this is where that focus on late payments comes in, isn't it? You mentioned SMEs earlier.
Precisely. A core required disclosure here is their policy specifically to prevent late payments, with particular emphasis on payments to SMEs. This isn't just a general statement. It's about their concrete approach to this specific, often high-impact issue.
Got it. What else do they need to reveal about supplier relationships more broadly?
Well, they must describe their overall approach to managing these relationships. They need to consider the risks the supply chain poses to the company, like disruption, but also the supply chain's impacts on sustainability matters, like labor practices or environmental footprint down the chain.
Two sides of the coin.
Exactly.
Right.
And they also need to state whether and how they incorporate social and environmental criteria when they're selecting suppliers in the first place.
So moving beyond just price and quality, are there other insights they could offer on this, maybe optionally?
Yeah, Appendix A lists several optional points that can really add depth. They may discuss how their supplier practices support their strategy or risk management, for example, how robust relationships help avoid disruptions. They could talk about training or incentives for this procurement staff, noting if incentives are linked to more than just price, perhaps incorporating sustainability factors.
Interesting.
Other options include how they screen supplier performance, their approach to including local or certified suppliers, or how they engage with vulnerable suppliers.
And vulnerable suppliers means?
The standard defines those as suppliers exposed to significant economic, environmental, and/or social risks. So thinking about those who might be disproportionately affected by certain practices.
Yep.
They could also report on targets for communication with suppliers or how they evaluate outcomes, perhaps through audits or surveys. Lots of potential detail there.
That really paints a picture of how integrated or not sustainability thinking is in their core purchasing decisions. Moving on, let's talk about the specific system for combating corruption and bribery. That's G1-3.
Correct, G13. This section requires companies to detail the procedures they have in place to prevent, detect, investigate, and respond to any allegations or confirmed incidents of corruption and bribery. It also covers the training associated with this system.
And the objective.
Simple transparency, really. Provide transparency on these critical anti-corruption measures.
What specific procedures do they have to describe? Is it just a high-level overview?
No, it's fairly detailed. They must describe their core prevention, detection, and response procedures. And a key piece of transparency here is stating whether the individuals or committees responsible for investigations are independent.
Meaning?
Meaning they are separate from the management chain that might actually be involved in the issue being investigated.
Oh.
Ensures objectivity.
Makes sense.
They also need to describe their process for reporting the outcomes of these investigations up the chain to the administrative, management, and supervisory bodies, basically, board oversight.
And again, the state, if you don't have it rule, applies here too, like with the policies.
Exactly. If they lack these procedures, they must disclose that fact and outline any plans to adopt them. They also have to explain how they make these policies and procedures known to everyone who needs to see them.
Not just employees.
Right. Employees, contractors, suppliers, value chain workers, even investors. Appendix A suggests mentioning communication tools and efforts to remove barriers, like using translations or clear graphics. Accessibility is key.
Yeah, communication is vital if these policies are going to be effective in practice. What about the training component?
Required disclosures here include the nature, scope, and depth of their anti-corruption and anti-bribery training programs. They also have to report the percentage of their functions at risk that are covered by this training.
And functions at risk means what exactly?
The standard defines these as the roles or tasks within the company deemed to be at a higher risk of encountering or being involved in corruption or bribery based on their responsibilities.
So it's about targeted training.
Exactly. It emphasizes targeted training where it's most needed. They must also disclose the extent to which their leadership bodies, board members, top executives receive this training. Appendix A also mentions that they may optionally provide analysis of this training by region or worker category for added detail.
Okay, switching from policies and procedures to the actual numbers, the metrics, what do they have to report if corruption or bribery incidents do occur? G14.
Yes, G14 focuses on incidents during the reporting period. The objective here is direct transparency on what happened and, well, the consequences.
What specific metrics must they disclose? What's the bare minimum?
They are required to disclose the number of convictions against the company and the total amount of fines levied for violating anti-corruption or anti-bribery laws.
Okay, convictions and fines.
And they also have to report on any actions taken to address breaches of their own internal procedures or standards that were uncovered during investigations.
And what can they report beyond that mandatory stuff? Optional metrics.
They may provide the total number and nature of confirmed incidents. They could report how many of their own workers were dismissed or disciplined as a result, and how many contracts with business partners were terminated or not renewed due to violations.
That gives more context.
Definitely. They can also provide details on public legal cases related to corruption or bribery brought against the company or its workers during the period, including their outcomes.
Now, does this cover incidents anywhere in their supply chain, even if their own staff weren't directly involved? How far does it reach?
That's an important point. The standard is specific on this. These disclosures include incidents involving actors in its value chain only where the company itself or its employees were directly involved.
Oh, okay.
It's focused on the undertaking's direct implication, not necessarily systemic issues across the entire value chain unless they were a party to it.
That scope is important to understand. Okay, let's move to the next metric section, G15, and this one sounds particularly intriguing. Political influence and lobbying.
It is indeed. G15 requires information on activities and commitments related to exerting political influence. This specifically includes lobbying that's linked to their material impacts, risks, and opportunities, their IROs.
And the objective, more transparency.
Transparency, yes, about these activities and also the purpose behind them. Why are they lobbying on certain issues?
What are the mandatory disclosures here? What do they have to tell us?
Well, if applicable, they must identify which representative or group within their leadership bodies, their board or management, is responsible for overseeing these political influence activities.
So who's the top person accountable for lobbying oversight? Got it.
Exactly. Then, for any financial or in-kind political contributions they make.
In-kind meaning?
Like non-monetary support, maybe loaning staff, providing facilities, that kind of thing. Appendix A defines both direct and indirect contributions. For those contributions, they have to disclose the total monetary value. This needs to be aggregated by country or geographical area, and by the type of recipient, like a political party, a candidate, or maybe a think tank. And if they make those non-monetary in-kind contributions, they must explain how they estimated the value.
Right. And what are they actually lobbying on? Do they have to spell that out?
Yes, and this is a really significant requirement. They must disclose the main topics their lobbying activities cover and their main positions on those topics.
Okay.
And, crucially, they need to explain how this lobbying interacts with the material impacts, risks, and opportunities they've identified and reported elsewhere.
Ah, so that links their public lobbying efforts directly back to the sustainability issues they've deemed most important. That's a powerful connection.
It forces companies to show how their actions align, or perhaps don't align, with their stated priorities. They also have to state if they are registered in the EU or a member state transparency register and provide their ID number if they have one.
There was also that specific, quite surprising requirement in the sources about people joining their board, wasn't there? Something about former public officials.
Yes, this is a really specific and quite insightful requirement. It seems designed to capture potential influence dynamics. The company must disclose information about the appointment of any members to their administrative, management, or supervisory bodies who held a comparable position in public administration.
Including regulators.
Including regulators, yes, in the 2 years before joining the company's board, if that appointment happened during the current reporting period.
Wow.
Appendix A gives guidance on what comparable position means, looking at the level of responsibility and scope in their previous public role.
So bringing former regulators or senior public officials onto the board has to be disclosed. That seems designed to make potential revolving door scenarios transparent.
That's certainly the implication, shining a light on appointments that could involve prior relationships or expertise gained from a public position relevant to the company's activities.
Interesting. Are there optional disclosures here too?
Yes, Appendix A mentions optional disclosures for lobbying, like reporting total internal and external lobbying expenses or membership fees paid to lobbying associations. And importantly, Appendix A reinforces that companies, when reporting on lobbying topics and positions, should consider the alignment between their public statements on their material IROs and their actual lobbying activities.
Right.
It's not a mandatory metric to report non-alignment, but it's a strong suggestion embedded in the guidance, basically. Check yourself.
That consider alignment point is key. It's asking them to reflect on potential contradictions between what they say publicly about sustainability and what they lobby for privately. Okay, finally, let's look at G16, payment practices. Back to the suppliers.
Yes, this gets right back to that concrete high-impact area we mentioned earlier. It requires companies to provide information on their payment practices with a specific focus on late payments to SMEs.
And the objective?
To give users insights into their contractual payment terms and, critically, their actual performance against those terms, especially concerning SMEs who rely on timely payments.
What specific numbers do they have to report on payment practices? What's the key metric?
They must disclose their average time it takes to pay an invoice, stated in days.
Simple, clear, and very relevant for a supplier waiting to get paid.
Exactly. Very direct. They also have to provide a description of their standard payment terms, also in days, broken down by the main categories of their suppliers. Maybe wholesalers are different from service providers, etc.
Okay.
And alongside this, they must disclose the percentage of their payments that were actually made in alignment with those standard terms. Appendix A notes that standard terms can vary by country or supplier type, and companies should provide this context.
The source materials even gave that helpful ABC example to show how this might look in practice, didn't they?
They did. That example from Appendix A is quite good. It shows a company, ABC, reporting different standard terms. Maybe payment on receipt for wholesalers, 30 days for services, 60 days for others generally, but maybe 90 days in country X for specific reasons.
Right.
They then show the percentage of invoices covered by each term category, and presumably, though it wasn't explicit in that snippet, they'd report how well they adhere to those terms for each category. It makes it very tangible.
Are there any other mandatory disclosures here for payment practices?
Yes, one more key one. They must report the number of currently outstanding legal proceedings they're involved in, specifically related to late payments.
Ah, okay. Legal challenges.
Right. And finally, they need to provide any other complementary information necessary for users to understand the data. Like if they used a sampling methodology to calculate the average payment time, they need to explain how they applied it.
So bringing all these pieces together then, from culture and whistleblowers, supplier payments, lobbying, what does the picture painted by ESRS G1 reporting really offer us, the users of these reports?
Well, collectively, these disclosures move beyond abstract statements or vague commitments. They provide a structured, detailed, and increasingly standardized view of a company's ethical foundation, how it manages crucial operational relationships, like those with its suppliers, and how it seeks to influence the external environment, including politics.
And for you, the listener, the learner, why is all this granularity so valuable? Why should you care about these specific disclosures?
Because it gives you a tangible framework to look beyond the financial headlines or, the glossy marketing materials. It offers crucial context for evaluating a company's true sustainability, its operational integrity, and its corporate responsibility.
So it's about getting real evidence.
Exactly. It points to specific policies, procedures, and even metrics you can look for to understand how a company actually operates on key conduct issues, rather than just what it says it believes or aspires to.
It feels like standards like this are really pushing companies into revealing information that was previously hidden, maybe, or just not considered relevant for public reporting.
Absolutely. They are demanding transparency in areas critical to a company's real-world impact and ethical standing, providing stakeholders, investors, employees, customers, everyone with vital insights.
So we've taken a pretty deep dive into the specifics of ESRS G1 business conduct reporting, covering everything from the expected policies around ethics and whistleblowers, through the management of supplier relationships, the fight against corruption, and that often opaque world of political influence and lobbying, right down to the nitty-gritty of payment practices.
It's definitely a comprehensive look at how sustainability reporting is maturing, requiring detailed disclosures on these really fundamental aspects of corporate behavior.
So here's a final thought for you to consider as you mull over these requirements. Knowing that companies now have to report on topics like their policies to prevent late payments to SMEs or disclose former regulators sitting on their board, and are actively encouraged to consider the alignment between their public sustainability commitments and their actual lobbying efforts. How might this big push for transparency fundamentally change corporate behavior and maybe shape public trust in the long run? Something to chew on. Welcome to the deep dive. Today, we're getting into something, well, fundamental to understanding any company. It's people. We're taking a deep dive into a specific part of the European Sustainability Reporting Standards, ESRS S1. This one focuses entirely on a company's own workforce.
That's right, and our source material today, it comes straight from the official ESRS S1 document itself. It is detailed, yes, but it's really designed to give anyone looking at a company's sustainability report a clear, sort of unvarnished view of how it treats, manages, and importantly, depends on its workers.
Exactly. And that's our mission for this deep dive, to unpack this standard, understand exactly what companies are required to, well, lay bare about their employees and other workers, and critically, why this level of transparency is so valuable for you in assessing an organization. We'll pull out some of the most specific, maybe even surprising requirements, things that go way beyond generic HR speak.
Yeah, because the real value here isn't just knowing companies have policies on paper. It's seeing the data, the processes, the commitments that actually back them up. This standard helps users get a truly comprehensive view of a company's social impact and, the related risks and opportunities tied directly to its people.
Okay, let's unpack this then. Diving into the standard itself, what's the very first thing it aims to achieve? What's the core objective of ESRS S1?
Well, at its heart, ESRS S1 aims to enable anyone using a company's sustainability statement to understand its material impacts, risks, and opportunities related specifically to its own workforce. It's pretty foundational for understanding a company's social footprint and its resilience, really.
And who counts as part of this own workforce? Is it just, the folks on the payroll in the head office?
No, not at all. The scope is intentionally broad. Own workforce includes both employees and non-employees who provide work or services for the company. So that means your full-time staff, yes, but also potentially self-employed contractors, agency workers, or even people working via third parties if they are, sort of essentially integrated into the company's operations. It captures a much wider range of working relationships.
That broad scope makes sense. Definitely reflects the complexity of modern workforces. So, armed with the information from an S1 disclosure, what kinds of insights can a user actually gain about a company?
You can learn quite a bit. The standard is structured to help you understand how the company impacts its own workforce, both positively and negatively. Also, the concrete actions it takes to prevent or fix issues, how it manages risks and opportunities related to its people, and even the extent to which the company actually depends on its workforce.
And I noticed the source mentions the financial side, too. That seems important.
Yes, crucially. Companies must disclose the financial effects related to the material risks and opportunities arising from the own workforce. So this links things like workforce stability, well-being, availability, links them directly to the company's potential financial performance.
That's a key connection, one that many traditional reports might miss.
Exactly. The standard also requires an explanation of the company's overall approach to identifying and managing impacts on its workforce across core areas: working conditions, equal treatment, and other work-related rights.
And this isn't just a new, isolated requirement, is it? The source makes it clear S1 is built on existing, established foundations.
Precisely. This standard is designed to align with major international human rights instruments and conventions. Things like the UN Guiding Principles on Business and Human Rights, the ILO Declaration, and the European Pillar of Social Rights. It's definitely rooted in universally recognized principles.
What's particularly interesting to me is how deeply the standard requires these workforce issues to be woven into the company's core strategy.
Yes, this is where it connects beyond just HR compliance. Disclosure Requirement SPM2, which links to the general ESRS2 standard on strategy. It asks how the company's strategy and business model take into account the interests and views of its stakeholders, specifically calling out the own workforce and their representatives.
So the question is, are workers' perspectives actually informing the big picture direction of the company?
That's exactly the question this disclosure is designed to help answer. Then SPM3 delves even deeper. It requires disclosure on how material workforce-related impacts, risks, and opportunities interact with and potentially even reshape the company's strategy and business model. Are labor shortages changing their expansion plans? Is a highly skilled workforce enabling a completely new strategic direction? That kind of thing.
This sounds like a very clear application of double materiality we hear so much about.
It is. The standard covers the impact on the workforce. That's the traditional social aspect, and the risks and opportunities for the undertaking that stem from workforce issues. That's the financial materiality piece. It's about seeing both sides: the company's effect on people and, well, people's effect on the company.
Okay, moving from strategy, how does the standard get into the practical side? Like how companies are expected to manage these workforce issues day to day.
Right. This is where we get into the policies, processes, and actions. First up, Disclosure Requirement S11 lays the groundwork. It requires companies to disclose their policies related to their own workforce.
And the list of policy areas mentioned in the source is quite extensive, isn't it?
It really is. It covers everything from secure employment, working time, adequate wages, social dialogue, collective bargaining, work-life balance, health and safety, gender equality, training, support for persons with disabilities, anti-harassment, diversity, right through to policies against child labor and forced labor. It's meant to show the breadth of their stated commitments.
Okay, so they state their policies. But how do they ensure these aren't just, words gathering dust on a shelf? How do they actually engage with their workforce about these crucial issues?
That's covered in S12. It requires disclosing the processes for engaging with the own workforce and their representative about material impacts. This means describing how they engage, how often, who is involved, and critically, this is key, how the results of that engagement actually inform decision-making. The source points out this can happen at different levels, company-wide, site-specific, or for particular projects.
Yeah, that last part feels vital. Showing the engagement isn't just for show. It leads somewhere. What if something does go wrong, though, or a worker has a concern?
That's addressed by S13. This requires disclosing processes for remediating negative impacts and the channels available for workers to raise concerns. The standard places a strong emphasis on grievance mechanisms, how issues are raised, how they are addressed, and whether the company assesses the effectiveness of these channels. And a really crucial point here is the requirement to ensure non-retaliation for raising concerns. That detail is critical for a functional system, obviously.
Makes sense. So policies, engagement, ways to fix problems. Then S14 seems to be about the concrete steps taken, the actions.
Exactly. S14 requires disclosure about the specific actions the company takes to address material impacts, manage risks, and pursue opportunities related to the workforce. It moves beyond just stating intentions to detailing the actual steps, the approaches to risk management and opportunity pursuit, and how the company assesses the effectiveness of these actions. You know, do their actions actually match their stated policies and the issues raised through engagement?
Right, and this is where the numbers come in to really tell the story, isn't it? The standard gets very specific with metrics.
Absolutely. This is where the qualitative policies and processes meet the quantitative data. S15 starts with targets. Companies have to disclose specific, measurable targets related to managing impacts, risks, and opportunities. The source gives examples like targets for increasing secure employment contracts or managing temporary working time arrangements. They actually have to put numbers on their goals.
And then they have to put numbers on the workforce itself, broken down in pretty specific ways.
Yes, S16 covers characteristics of employees, and this isn't just a total headcount. It requires total number in headcount and full-time equivalent FTE. Then broken down by gender, specific age groups under 30, 30, 50, over 50, and geography. Plus, detail on permanent versus temporary status and full-time versus part-time. And importantly, they need to report employee turnover.
Employee turnover, okay. What about the non-employees you mentioned earlier, the contractors and agency staff?
S17 covers non-employees. Companies must disclose their total number and clearly describe the types included, like self-employed or agency workers. This really sheds light on the structure of their sort of extended workforce.
Interesting. And worker voice is also quantified to an extent.
It is in S18. Companies disclose the percentage of employees covered by collective bargaining agreements. That's a key indicator of formal worker representation. And also information about the existence of works councils or similar social dialogue bodies.
Now let's talk about fairness and inclusion. There are some particularly revealing metrics here, it looks like.
Yes, definitely. S19 requires disclosure on diversity. Specifically, gender diversity figures at the top management level and across all employees, broken down by those same age groups. Then S112 requires the percentage of employees with disabilities.
And S116 on remuneration, wow, this gets very specific. This feels like a place where the numbers can really challenge the narrative, potentially.
Oh, this is a crucial one for many users, I think. S116 requires the gender pay gap, the difference in average pay between female and male employees, expressed as a percentage. And importantly, this isn't just about equal pay for equal work. It can reveal systemic differences in pay levels across the whole organization. It also requires the annual total remuneration ratio, comparing the highest paid individual's total pay to the median employee's total pay. And these have to be broken down by employee category and region, providing real insight into pay equity and distribution.
That level of detail on pay is really significant. What about ensuring workers earn enough to actually live on?
That's addressed in S110, covering adequate wages. This is a really crucial disclosure point. Companies must state whether all employees are paid an adequate wage. And the standard clarifies that adequate wage benchmarks can include things beyond just the national minimum wage, like the EU Minimum Wage Directive, ILO conventions, or recognized living wage benchmarks, such as those from the Fair Wage Network. The focus is on the lowest paid category in relevant regions. It really pushes companies to think about a wage sufficient for a decent standard of living, not just the legal minimum.
That moves the conversation beyond pure compliance to actual impact. What about health and safety?
S114 covers health and safety. Companies must report work-related fatalities, the rate of recordable work-related accidents and ill health, and the number of days lost due to these issues. These are, hard numbers on the human cost of work. They also disclose the coverage of their health and safety management system.
And work-life balance is also measured, right?
Yes. S115 requires reporting on family-related leave. That's maternity, paternity, parental, and carer's leave. They must disclose the percentage of employees entitled to this leave and provide a gender breakdown, which can show how these policies are actually being accessed by men and women.
And finally, there's a section that covers, well, the really serious stuff, human rights impacts.
Right. S117 addresses this. It requires disclosure on work-related incidents, complaints, and severe human rights impacts. This includes incidents related to discrimination, harassment, child labor, forced labor, and human trafficking. The disclosure covers the number reported, broken down by type, and details any fines, penalties, compensation paid, and importantly, remediation plans. This is really about transparency on the most serious potential issues a company might face related to its workforce.
That requires reporting on incredibly sensitive but absolutely vital issues for understanding a company's true impact.
Exactly. It forces companies to acknowledge and quantify these severe issues if they occur.
So pulling all of this together then, we've gone from high-level strategy and policies all the way down to these very specific numbers on pay gaps, incident rates, even who is covered by collective bargaining.
That's the comprehensive view ESRS 1 is designed to provide. It's a structured way to look at a company's most important asset. It's people.
And why is having access to this level of detail so powerful for you as someone trying to understand a company? What's the real benefit?
Well, because it moves beyond the generic statements you might find in marketing materials or, older CSR reports. It provides concrete, comparable data points and process descriptions that allow you to assess how a company is actually managing its relationship with its own workforce. You can see potential red flags,
Right.
identify positive practices perhaps, and get a much clearer picture of how workforce issues link to the company's overall stability, resilience, and potential financial performance. It really helps you see behind the curtain.
It really gives you the tools to evaluate whether a company's actions truly match its words when it comes to its people. Okay, we've taken a serious deep dive into what ESRS One-Own Workforce requires companies to report.
And we've seen how it provides a structured, data-driven framework for understanding how a company treats its most valuable asset.
So here's a thought for you to chew on as you consider company disclosures going forward. Think about the link between those detailed quantitative metrics required by this standard, the numbers on things like the gender pay gap, employee turnover, work-related injury rates, or adequate wages. Think about the link between those numbers and the more qualitative disclosures about policies, engagement processes, and grievance mechanisms. How do those hard numbers validate or perhaps challenge the company's stated intentions and processes regarding its own workforce?
Does the data actually support the story the company's telling?
Indeed. A crucial question. Thanks for joining us on this deep dive.
You buy something, right? A t-shirt, maybe your coffee, a new phone. It shows up, you use it. Seems simple.
Yeah, on the surface.
But behind it, there's this huge, invisible network of people. The farmers, the miners, factory workers, the people driving the trucks.
Absolutely, the whole global value chain.
And, how they're treated.
Yeah.
That's often not simple at all, is it? And definitely not always transparent.
Not historically, no.
And I think as, consumers, investors, just people,
Mm.
we're getting more aware of this whole complexity. And the rules are starting to catch up.
That's right, regulations are evolving.
So today, we're doing a deep dive into a really key piece of that, specifically in the European Union.
Mm.
We're focusing on ESRS S2. That's one of these new European sustainability reporting standards. And this one, S2, is all about workers in the value chain.
A very specific focus.
Exactly. And our source is the standard itself, the actual document laying out what companies under EU rules have to report.
Straight from the horse's mouth, so to speak.
Yeah. And our mission really is to cut through all the, let's face it, dense regulatory language.
Can be quite technical.
Right. We want to understand what this standard actually asks companies to look at, why it's such a big deal, and what it's trying to achieve for all those workers out there, and importantly, for the companies themselves.
Yeah, the link is critical.
Think of this as your essential guide to understanding this piece of sustainability reporting that really centers on people.
Okay, let's do it.
Okay, let's unpack this standard.
Well, what's really striking, I think, is just how ambitious it is. The sheer breadth of it. It's not just asking about a company's own employees.
Right. You mentioned that's a different standard, S1.
Exactly. ESRS S2 makes companies look outwards. It wants them to enable anyone reading their sustainability report, investors, NGOs, to really get a handle on the material impacts on workers all the way through their value chain.
Actual and potential impacts.
Both. Positive and negative, identifying what those impacts really are.
Okay, so if I'm reading a company's report that follows S2, what should I be learning? What kind of picture should emerge?
You should get a clear view on a few core things.
Yeah.
First, those impacts. How is the company actually or potentially affecting workers in its value chain?
Okay.
Second, what's the company doing about it? The actions they're taking to prevent problems or fix them or maybe support positive changes. And crucially, is any of it actually working?
Right, the effectiveness piece.
Yeah. And third, and this loops back to the business side. What are the risks and opportunities for the company itself that stem from these worker impacts? And how are they managing those? And finally, they want to see the potential financial effects, short, medium, long term. So it really connects the dots between how workers are treated and the company's bottom line, or at least its financial outlook.
That financial link feels really significant. Now,
Yeah.
you stress this isn't about the company's direct employees, so this term, value chain worker, who exactly falls under that umbrella?
Yeah, this is a really important distinction they make. So ESRS S1 covers the own workforce, employees, agency workers directly controlled, that kind of thing. ESRS S2 covers value chain workers,
Which means?
which means basically all other workers, upstream and downstream, who are or could be materially impacted by what the company does, its operations, its products, its services, even just its business relationships.
Okay, can you give some examples? It sounds potentially huge.
It is, and the standard gives some helpful pointers. Think about, say, the catering staff or the security guards who work on the company's premises but are actually employed by an outsourced company. They're value chain workers under S2.
Ah, okay. Even if they're physically there.
Right. Or workers in a supplier's factory, maybe thousands of miles away. Or staff working for a retailer who sells the company's products downstream.
On stream too, right?
Yeah. Or even like technicians who come on site sometimes to do maintenance but work for the equipment supplier. And then you get into the really deep parts of the chain. Think about workers extracting the raw minerals or harvesting the cotton that eventually becomes the company's product.
Yeah.
It's designed to be very comprehensive.
Wow, okay. That really does cast a wide net. So what aspects of these workers' lives are companies supposed to be focusing on? What kind of impacts?
It drills down into core human and labor rights. The standard asks companies to explain how they manage impacts related to a few key areas.
Right.
First, working conditions. This is broad things like secure employment, reasonable working hours, getting an adequate wage, the ability for workers to engage in social dialogue, freedom of association, so, unions, collective bargaining.
The fundamentals.
Exactly. Plus work-life balance, and of course, health and safety, a huge one.
Okay, what else?
Then there's equal treatment and opportunities. This covers gender equality, equal pay for equal work, access to training and skills development, making sure persons with disabilities are included, tackling violence and harassment, and promoting diversity generally.
Right.
And finally, other work-related rights. This is where you find the absolute prohibitions, child labor, forced labor, but also things like adequate housing or water and sanitation if the company is involved in providing those, and respecting workers' privacy.
So it's basically the whole spectrum of internationally recognized labor rights, but applied across this huge extended chain.
That's the idea, respecting these fundamental rights throughout the value chain.
Okay, but how does, let's say, a problem with working hours for a farm worker way upstream, how does that become a risk or maybe an opportunity for the big company sitting in Europe?
Now that's where it gets really interesting, and where the standard tries to make that business case explicit. It argues negative impacts are business risks.
How so?
Well, imagine forced labor is found deep in your supply chain. Suddenly, there's a risk your goods could be seized at the border by customs authorities in, say, the US or EU. That's a major operational disruption.
Okay, direct hit.
Or think about reputation. Bad press about worker exploitation, even by a supplier's supplier, can seriously damage a brand. Consumers might walk away. Investors get nervous.
Mm-hmm.
The standard points out other things, too, like heavy reliance on poorly supported contract workers during a pandemic.
Right.
That showed massive business continuity risks. Or constant price pressure on suppliers. That can force them to subcontract, maybe to places you don't even know about, making the chain less transparent and potentially riskier.
Less visibility, more risk.
Exactly. And even things like exploiting low-paid workers. Maybe it saves costs short-term, but the standard frames it as a reputational and business opportunity risk long-term. Plus, skills shortages in your value chain are a direct threat.
Yeah. Okay, so lots of potential downsides. What about the flip side, the opportunities?
Right. It's not all negative. Respecting rights, running support programs that can build a more stable, reliable supply chain. Suppliers with good labor relations are less likely to have strikes or disruptions.
Makes sense.
It can also be a market differentiator, appealing to consumers who care about ethical sourcing. And thinking long-term, like ensuring coffee farmers earn enough to stay in business, that's managing an impact, sure, but it's also securing your future supply of coffee beans. That's a clear opportunity.
So under this standard, treating workers well isn't just portrayed as, nice to have CSR. It's framed as core to business risk management and future strategy.
Precisely. It connects social performance directly to business resilience and potential growth.
Okay, so if that's the why, let's get into the what. What do companies actually have to tell us? What are the disclosure requirements?
They structured around a few key areas, basically asking companies to explain their approach. It follows a common pattern: strategy, impact, risk, opportunity management, and then metrics and targets.
Got it. Strategy first.
Yeah. First, strategy. This links back to some core ESRS requirements. Companies need to show how the interests, the views, the rights of these value chain workers, who they need to see as key stakeholders, how that actually feeds into their overall business strategy and model.
So not just an add-on, but integrated.
That's the goal. They need to explain how impacts on workers, good or bad, actually connect to or maybe even stem from their business model. And then, crucially, how understanding that connection might lead them to adapt their strategy or model.
Okay. What kind of specifics are needed there?
They need to describe the types of value chain workers who might be affected. Are they on-site but outsourced? Upstream, downstream, in joint ventures? And critically, they have to explicitly identify and describe any groups of vulnerable workers.
Vulnerable workers. What does the standard mean by that?
It gives examples. Think about young workers who might be at risk physically or mentally, women workers facing discrimination, migrant workers who can be exploited through recruitment fees or lack of regulation, workers handling dangerous substances or equipment, or even low-paid workers on precarious, like, 0 hours contracts. The company needs to show they've thought about who might be most at risk in their specific value chain.
So it requires some real analysis, not just generic statements.
Definitely. They also need to flag if there are specific regions or commodities known for high risks of, say, child labor or forced labor, and whether the negative impacts they see are like systemic problems in a whole sector or country, or more related to specific incidents.
And positive impacts, too.
Yes, they should also briefly describe activities creating positive impacts, maybe improve purchasing practices, capacity building with suppliers, job creation, helping workers transition in a just transition context, and then summarize the main risks and opportunities that arise from all these impacts and dependencies.
Okay, so strategies about showing they understand the connections between their business and worker impacts, including identifying the hotspots.
Exactly. It's about showing this is part of their core thinking.
Right, so after strategy, what's next? The how.
Pretty much. That's the big section on impact, risk, and opportunity management. This is where they detail their approach. It starts with policies, S21.
Okay, what policies?
Companies have to describe their policies for managing these material impacts, risks, and opportunities relating to value chain workers. The key here isn't just saying, we have a policy, but explaining how comprehensive it is. Does it cover identification, assessment, management, and remediation?
And what should be in those policies?
They should align with international human rights standards, especially the UN Guiding Principles on Business and Human Rights, the UNGPs.
Right, the global benchmark.
Yeah. The policies need to reflect a commitment to respect human rights, engage with affected people, and provide remedy when things go wrong. And critically, they must state explicitly if their policies address the big issues: human trafficking, forced labor, compulsory labor, and child labor.
They have to call those out specifically?
Yes, and they need to say if they have a supplier code of conduct, and if that code covers key worker issues like safety, fair wages, those severe labor rights abuses aligned with ILO core conventions.
So comprehensive policies linked to global standards. What else in management?
Next is engagement, S22. This is about how companies actually talk with workers or their representatives, or maybe credible proxies like local NGOs or unions who understand the situation on the ground.
So finding out what workers themselves think.
Exactly. The goal is to see if and how worker perspectives are actually being heard and considered. Companies need to describe who they engage with, how often, who inside the company is responsible. Are there formal agreements with global unions? How do they even know if their engagement is effective?
And does it mention vulnerable workers again here?
Yes, it specifically calls for attention to engaging potentially vulnerable groups. And if a company doesn't have a general process for engaging value chain workers, they have to state that and maybe explain if they plan to implement one.
This really does seem key. Are they actually talking to the people affected?
It's fundamental to the whole due diligence idea, yeah. Then, okay, what happens when impacts do occur? That leads to remediation and channels, S23.
Fixing problems and ways to report them.
Right. Companies need to disclose their approach to providing remedy or cooperating in providing it, putting things right. And they need to describe the channels available for workers to raise concerns or grievances.
What kind of channels?
Could be company-run hotlines, could be supporting third-party mechanisms, could be through unions, dialogue processes, even findings from audits. They need to explain how they support or require these channels to exist in their value chain workplaces.
And just having a channel isn't enough, I guess.
No way. The standard pushes further. It asks if companies check whether workers actually know about these channels and, crucially, whether they trust them. Are there policies protecting workers from retaliation if they speak up?
Trust and non-retaliation. Vital.
Absolutely. The standard even points to international principles for assessing effectiveness. Are the channels accessible, predictable, fair? Do they lead to outcomes compatible with human rights? Again, if a company doesn't have these channels or processes, they need to say so.
Okay, policies, engagement, remedy channels. What's the last part of management?
It's taking action and effectiveness, S24. This sounds straightforward, but it's about the concrete steps. What actions are they taking or planning to take to prevent or mitigate negative impacts? What are they doing to provide or enable remedy? Are there additional positive impact initiatives?
And the effectiveness question again.
Always, they need to track and assess the effectiveness of all these actions. How do they identify what action is needed? Are they changing their own purchasing practices? Are they doing capacity building with suppliers, collaborating with others, using their leverage?
Using leverage, that sounds important.
It is, and a really critical point here, paragraph 35, is about avoiding causing or contributing to harm through their own practices. Like, does intense pressure on price or delivery times from the company itself undermine efforts to improve conditions down the chain? They need to report on how they manage that tension.
That's getting quite searching.
It is. They also need to report on severe human rights issues or incidents identified in their value chain and explain how they track effectiveness audits, impact assessments, worker feedback, grievance data, ratings, benchmarks.
So it sounds like they really need to show their homework, not just list activities, but prove they're actually making a difference.
Exactly. Effectiveness reporting needs to link actions to outcomes for workers. So not just we did training, but we did training, and subsequent worker surveys and safety data show conditions improved. That's the level of detail ideally sought.
Linking actions to results.
Yes, and maybe linking positive initiatives to worker needs, perhaps even to things like the UN Sustainable Development Goals, like SDG 8 on decent work, showing resources allocated, how it's integrated into risk management. It's about demonstrating a systematic approach.
Right. Policies, engagement, remedy, action, and proving it works. That's a lot under management. What's the final piece?
The final piece is metrics and targets, S25. Companies need to disclose time-bound, outcome-oriented targets.
Goals for improvement.
Exactly. Targets for reducing negative impacts, for advancing positive impacts, and for managing those related risks and opportunities we talked about.
And it's just about setting a number.
No, the standard again asks about the process. How were these targets set? Were workers or their reps involved? How is performance tracked against the target? What are the lessons learned?
So involving workers in setting the goals too.
Potentially, yes. The guidance suggests disclosing that. And targets should ideally focus on intended outcomes for workers. They can link risk opportunity targets to impact targets, like a target for suppliers to pay a living wage, improves worker outcomes, and reduces supply chain risk. They can set short, medium, and long-term targets. It's about showing direction and measuring progress.
Phew. Okay. That is a really detailed framework for looking at workers way beyond a company's direct payroll. So stepping back, what does this all mean? What's the big picture here?
I mean, it signifies a real shift. Sustainability reporting, at least under ESRS, is getting much more granular and, frankly, much more focused on the actual human beings involved in these complex global value chains.
It's moving beyond just environmental metrics.
Massively. ESRS S2 gives this very specific, quite demanding structure for companies to really dig deep, understand their impact on people, often people they don't directly employ or even know, and then report transparently on how they're managing those connections, the risks involved, and any opportunities.
And for you, the listener, why does this matter?
Well, whether you're looking at a company as an investor trying to gauge long-term risk, or as a consumer wondering about the ethics behind a product, or just someone trying to make sense of how global business works, this standard provides a framework, a way to potentially see if companies are genuinely grappling with the human dimension of their value chain.
A lens to see who's taking it seriously.
Potentially, yes. It allows you to ask more informed questions, to look for that evidence of policies, engagement, action, and crucially, effectiveness. It's a tool to try and understand the human stories that sit behind the products and services we use every day.
It's definitely ambitious. I mean, this standard asks companies to understand and report on issues that can be incredibly complex, sometimes deliberately hidden deep within these sprawling value chains.
Yeah, the challenge is immense.
It asks about tracking effectiveness, about worker trust in grievance channels. So here's something to think about. Just how feasible is it for a huge global company to truly know and then accurately report on the lived reality of every single worker involved in bringing, say, a smartphone or a chocolate bar to you.
That's the million-dollar question, isn't it?
And what happens when this regulatory push for transparency crashes into the often murky, multi-layered, and frankly, quite opaque reality of these incredibly complex global supply networks? Where does that leave us? When a big company sets up shop or sources materials from halfway across the world, it really doesn't happen in a vacuum, does it?
No, definitely not.
Like a new factory changes things locally, water, air, jobs,
Sure.
and getting stuff like cocoa or cobalt, well, that affects the people living there, maybe indigenous communities even. Businesses just have these tangible impacts.
That exact relationship, that kind of two-way street between what a business does and the communities around it, that's precisely what we're digging into today. We're looking at a specific source, a detailed one, an excerpt from ESRS S3.
ESRS S3, right? That's one of the European sustainability reporting standards. And S3 is all about how companies report on their impacts on affected communities. Is that?
That's the one, yeah.
Yeah.
And our mission for this deep dive is really to unpack this standard, pull out the key requirements, the important insights, and figure out what it actually means for companies to be transparent about their social footprint, especially regarding the people, their operations, and crucially, their value chains touch.
So it's like a shortcut to understanding how this major reporting standard is pushing for more openness about social impacts.
Exactly. Think of it as getting a fast track on a really key piece of the puzzle for sustainability reporting.
Okay, let's jump in, starting right at the top. What's the main goal, the core objective of ESRS S3? What's it trying to achieve?
Well, the main objective is pretty straightforward, actually. It's to help anyone reading a company's sustainability statement understand its significant impacts on affected communities.
And not just the neighbors next door, right?
No, absolutely not. It includes communities linked through their whole value chain, their products, services, even their business relationships. It's broad.
Got it. And what specifically should I, as a reader of that report, understand from these S3 disclosures?
The standard lays out a few key things you should get. First, how the company affects communities. Is it positive, negative, happening now, or just a potential risk? And importantly, where are those impacts likely to be the most severe?
Okay, the how and where. What else?
Second, the actions. What is the company actually doing to prevent, reduce, or, fix negative impacts? And how are they handling the related risks and opportunities?
Right, the practical response.
Third, the report should explain the nature, type, and extent of the big risks and opportunities. And this isn't just from the impacts they cause, but also from the company's dependencies on communities.
Dependencies. That's an interesting term. It sort of implies the company needs the community, not just impacts it.
It does, exactly, like meeting local workers or maybe just needing the community's their trust to operate smoothly.
A social license to operate?
Precisely. And the standard really leans into this. It highlights that depending on a community for labor, land access, whatever, creates real risks if that relationship breaks down. Think disruptions, protests, bad PR.
But also opportunities.
Yes, definitely opportunities if the relationship is good. Easier hiring, smoother operations, maybe being seen as a partner locally. It really shows communities aren't just passive, they're actors the business relies on.
And the fourth thing to understand.
Yes, the financial side. Users should get a sense of the financial effects of these risks and opportunities on the company itself, short, medium, and long term.
Okay. Now, you mentioned impacts, but does the standard get specific about the kinds of impacts, particularly regarding human rights?
It does. It calls out certain rights explicitly. It covers economic, social, and cultural rights. Think basics like housing, food, water, land rights, security.
So fundamental needs.
Yes. And also civil and political rights, freedom of expression, assembly, the safety of human rights defenders. But a really key point, a specific focus, is on the particular rights of indigenous peoples.
Like what specifically?
Things like free, prior, and informed consent, FPIC, which is huge. Also self-determination and cultural rights. That explicit mention of indigenous rights in FPIC is, I think, a really significant aspect of S3.
It sounds quite comprehensive. Now, you mentioned this fits into a bigger picture. How does S3 interact with the other ESRS standards? It's not just on its own, is it?
No, definitely not. It's part of a whole system. Basically, S3 kicks in when a company does its materiality assessment. That's the process where they figure out their most important sustainability topics and finds that impacts, risks, or opportunities related to communities are, well, material, significant.
And that materiality assessment process is covered elsewhere.
Exactly. That's detailed in ESRS 2, which lays out the general requirements. So S3 needs to be read alongside ESRS 1 and 2, plus the other social standards S1 on the company's own workforce, S2 on workers in the value chain, and S4 on consumers. They're all interconnected.
Okay, so materiality triggers S3. Once it's triggered, how does the standard push companies to connect these community issues to their core strategy and business model? That seems like a really important link to make.
It's absolutely crucial. And yes, the standard really pushes for this. It wants companies to show that thinking about communities isn't just some side department thing. It needs to be baked into how they actually do business.
How does it require them to show that?
It points to specific requirements back in ESRS 2. For instance, companies have to explain how the views, the interests, the rights of affected communities, including human rights, indigenous rights, actually inform their strategy and their business model. It positions affected communities as key stakeholders whose input really needs to count at that high level.
And they have to show the connection between the impacts and their strategy, not just that they listened.
Precisely. They need to disclose how community impacts actually stem from or are linked to their strategy and business model. And, this is key, how those impacts might make the company change or adapt its strategy.
So it's a feedback loop.
Kind of, yeah. They also need to show how the major risks and opportunities that come from impacts and dependencies tie back to the strategy and business model. The insight here is that the standard wants proof that companies understand this cause and effect between their core business decisions and what happens to communities on the ground.
So it's not just, here are our impacts, but more like, here's how our business approach leads to these impacts, and here's how that might force us to rethink things.
Yeah.
That feels quite powerful.
It is. It moves beyond simple reporting.
Now, who exactly counts as an affected community? If they're materially impacted, who triggers these disclosures? Is it just people living right next door?
No, it's much wider, reflecting, how complex modern supply chains are. The standard includes communities near the company's own sites, factories, facilities, even remote ones, maybe downstream if there's pollution.
Okay.
It covers communities all along the value chain near suppliers, logistics hubs, distribution routes. It includes communities at the very ends, like where raw materials are extracted or where waste ends up. And again, it explicitly names indigenous peoples as potentially affected communities.
And the standard wants detail on the nature of impacts, too. Not just that impacts exist.
Yes, absolutely. Companies need to describe them clearly. Are they, widespread systemic issues in an area, say, ongoing health problems from pollution near a cluster of factories? Or are they specific incidents, a chemical spill, maybe? Or even conflict related to the company's presence, perhaps how security forces respond to protests.
That's quite specific.
It even mentions potential impacts from the green transition, like increased mining for critical minerals affecting local communities. And they need to distinguish between actual impacts and potential future impacts.
And you flagged something earlier, identifying communities at greater risk.
Yes, this is a really critical point of sensitivity in the standard. Companies must identify if certain communities are more vulnerable, maybe they're physically isolated or have limited access to services, or perhaps existing social structures make certain groups, like women, more susceptible to negative effects. Think about large land deals affecting women's traditional farming rights more than men's.
So it requires looking at intersectionality.
Exactly. The standard emphasizes looking at overlapping factors, ethnicity plus poverty, or migrant status plus gender. These intersections can really multiply the risk of harm.
Which means the risks and opportunities might be very specific to certain groups, not a general community issue.
Absolutely. A land rights issue might be acutely material for an indigenous group, but maybe not for residents near a corporate office. The company needs to show that level of understanding.
The standard gives examples of this strategic link.
It does. It gives examples of how strategy or business model choices can create risks. Things like setting project deadlines so tight there's no time for proper community consultation, or operating where land tenure is unclear or indigenous rights aren't respected by law. Even aggressive tax planning that hits developing countries' revenues, or maybe moving into high-risk areas leading to protests and delays.
What about resource use?
Yeah, intensive water use in a dry area leading to conflict, boycotts, lawsuits. It even covers low-likelihood, high-impact risks like dependency risks. Imagine a natural disaster causes an industrial accident that devastates a nearby community. The risk stems partly from that operational dependency on stable conditions right next to people.
Wow, that really connects the dots between high-level strategy and potential real-world harm. Okay, so companies identify all this. How does S3 then require them to show they manage it all? This looks like the biggest chunk of the standard.
It is quite detailed, yeah. It breaks down the management aspect into several key disclosure areas. First up, S31, policies.
So do they have the right rules written down?
Essentially, yes. They need to describe their policies for managing these material impacts, risks, and opportunities. The goal is to show they have formal frameworks covering the whole cycle, identifying issues, assessing them, managing them, and importantly, providing remedy if things go wrong.
Do they need to specify who the policies cover?
Yes. Do they apply to specific communities or all affected ones? Are there special provisions for Indigenous peoples? They also need to disclose relevant commitments to human rights, referencing international standards like the UN Guiding Principles or OECD guidelines, and explain how they check for compliance.
Focusing on.
Focusing on the material stuff. Respecting human rights, especially Indigenous rights, engaging properly, and having remedy processes. They even have to say if there have been reported cases where these principles weren't respected in connection with communities, either in their own operations or the value chain.
And it's not enough to just have the policy.
Right. The guidance adds that they need to explain how they communicate these policies. Who needs to know? Employees, contractors, suppliers, workers, investors, and crucially, the communities themselves. How do they do it? Flyers, websites, meetings. Is it translated? Are there graphics? It has to be accessible.
Okay, makes sense. Policies first. What's next?
Next is S32, engagement processes. Basically, how do they actually talk with communities?
Not just to them, but with them.
That's the idea. Companies have to describe their general processes for engaging with affected communities or their chosen representatives about impacts. The key objective here is for users to understand if and how the company engages as part of its due diligence. And critically, how do community perspectives actually feed into the company's decisions?
So again, it's about showing the engagement lead somewhere. It's not just ticking a box.
Precisely. They need to disclose details like, is engagement direct or through credible intermediaries? When does it happen? Project planning, operation, closure. What type of engagement? Is it just informing people, consulting them, or actively involving them in participation? How often does it happen?
Who's responsible internally?
Yes. Which function or senior role drives this? And how do they know if the engagement is even effective? They also need to show how they specifically engage vulnerable groups, like women and girls, and how they respect Indigenous people's rights. This includes consulting Indigenous communities on the way engagement happens, the mode, the parameters, not just the subject matter.
Consulting on the consultation itself, that's quite meta.
It is, but it reflects deep respect for the community's own protocols and decision-making processes. The standard explicitly links this to negotiating in good faith to get FPIC for anything affecting Indigenous lands, resources, culture, or involving relocation.
What if a company just doesn't have a process?
They have to disclose that. They can optionally provide a time frame for setting one up. The guidance also suggests giving details like staff training, especially on Indigenous rights, and providing real examples of where community input actually changed a company decision or plan.
Okay, policies, engagement. What about when things go wrong? Or communities need to raise a concern? That leads to S33, remediation processes and channels for raising concerns.
Right. This is all about pathways for fixing problems and making voices heard. Companies must describe how they provide or help provide remedy for negative impacts they're linked to. And they need to describe the channels available for communities to raise concerns.
So transparency on how communities can actually get issues addressed.
Exactly. Do communities have formal ways to communicate needs or complaints? Are these direct to the company or maybe through third parties like NGOs or industry bodies? They need to describe their general approach to remedy when they cause or contribute to harm, including how they check if the remedy actually worked.
What details do they need on the channels themselves?
They need to list the specific channels, grievance mechanisms, hotlines, dialogue processes, whatever they use. How do they support channels in their business relationships, like maybe requiring suppliers to have them? How do they track issues? And, crucially, how do they ensure the channels are effective? This includes getting input from the people who actually use them.
It sounds like it's about accessibility and trust, not just having a channel exist on paper.
Totally. They need to disclose if communities are even aware of these channels, and if they trust them, maybe using survey data. And very importantly, what policies are in place to protect users from retaliation, confidentiality, privacy, options for anonymity. These are vital.
And if they don't have channels?
Same as engagement. Disclose it, optionally provide a time frame. The standard points heavily to international guidelines, like the UNGPs, on what makes a grievance mechanism effective. legitimacy, accessibility, predictability, fairness, transparency, rights compatibility, continuous learning, and dialogue.
Anything specific for indigenous peoples here?
Yes, it mentions that remedy processes for Indigenous people should take into account their own customs, traditions, rules, and legal systems.
Okay, that covers the structures. Now for the actual doing. S3-4, taking action and effectiveness. This sounds like where the rubber meets the road.
It really is. This disclosure requires companies to get specific about how they act on all this, addressing impacts, managing risks, pursuing opportunities, and crucially, how they track the effectiveness of those actions. They need to summarize their action plans and the resources they're putting behind them, linking back to ESRS 2 requirements.
So what specific actions regarding impacts do they report?
For negative impacts, they list actions taken, planned, or underway to prevent or mitigate them, and actions for remedy if harm has already occurred. For positive impacts, they describe any additional initiatives they're undertaking. For both, they need to explain how they track and assess if these actions are actually working. Are they achieving the intended outcomes?
Do they need to explain how they decide what action to take?
Yes. The processes for identifying needed action, their approach to specific impact types, say, related to land acquisition versus operational pollution versus site closure, and how they make sure remedy processes are available and effective when needed.
And similar details for risks and opportunities.
Yep. Actions planned or underway to mitigate material risks, and actions to pursue material opportunities, along with tracking their effectiveness.
The standard also emphasizes actions within the company's own control, right? Their own practices.
Absolutely. It's about disclosing how they try to avoid causing or contributing to negative impacts through their own planning, financing, land use, resource extraction, environmental management, etc. This includes being honest about tensions, like how they balance preventing impacts against business pressures, like hitting deadlines or cost targets. They also need to report on any severe human rights incidents involving communities, if they occurred.
Now, here's a really interesting connection. The source makes linking community impacts directly to environmental issues.
Yes, this is super important and really breaks down silos. The standard is explicit. Environmental issues covered in ESRS E1 to E5 can directly cause major social impacts for communities.
Can you give some examples from the standard?
Sure. Think about climate change. E1. A big push for renewables is great, but if those projects are built on indigenous lands without proper consultation and consent, that's a huge social impact violating FPIC.
Okay, what else?
Pollution, E2. Factory emissions polluting air or water. That directly harms community health. Water use, E3. A company sucking up lots of water in a water-stressed area can literally reduce the drinking water available for locals.
Biodiversity, E4.
Yeah, biodiversity loss isn't just about animals and plants. Soil contamination from operations can destroy local farmers' livelihoods. Paving over land for development might remove plants that are critical for local biodiversity and water filtration, impacting the whole ecosystem communities depend on. Even introducing invasive species can cause harm.
And waste, E5.
Mismanaging hazardous waste, E5. That can have direct, severe health consequences for nearby communities. So the standard says companies should cross-reference these environmental disclosures when they lead to social impacts.
Wow, so environmental problems aren't separate. They are social problems for affected communities. Health, livelihoods, rights, it's all connected.
Exactly. It forces a more holistic view of sustainability.
What about impacts further down the value chain, often outside a company's direct control?
Good question. S3 addresses this through the concept of leverage. Companies need to disclose how they use their influence in business relationships to tackle impacts linked to, say, suppliers or distributors.
Leverage meaning?
It's not just commercial clout, like threatening to cancel a contract. It can be relationship leverage, maybe offering training to suppliers on indigenous rights, or collaborative leverage, working with other companies or organizations on shared challenges, like improving security practices in a volatile region.
So using influence positively.
Right. They can also report on participating in industry initiatives aimed at these issues. And they need to explain how community impacts are considered if they have to end a relationship with a problematic supplier or partner.
You keep saying effectiveness. How do companies actually measure if their actions are working?
The standard suggests various ways. They might use internal or external audits, look at outcomes of legal cases, conduct specific impact assessments, gather stakeholder feedback, analyze complaints from grievance mechanisms, look at external ESG ratings, or benchmark against competitors.
What about actions aimed at positive impacts?
Yeah.
Like community development projects?
For those, they should disclose if communities were involved in the design and implementation. What were the intended outcomes, and what were the actual achieved outcomes, making a clear distinction between just doing activities and achieving real results. Why were these communities chosen? Are there links to the Sustainable Development Goals like, does involving women in consultations support SDG 5 on gender equality?
Can positive actions also mitigate negative ones?
Yes, and they should mention that if it's the case. For example, maybe improving local roads near a facility not only helps the community generally, but also reduces traffic accidents involving company vehicles. That's a positive initiative mitigating a negative impact risk.
Okay, that covers actions. Finally, how does the standard push for measurable progress? That brings us to the last part, S35. Metrics and targets.
Right. Companies need to disclose targets. These should be time-bound, so with deadlines and outcome-oriented, meaning focused on results.
Targets for what, specifically?
For reducing negative impacts, advancing positive impacts, and managing those material risks and opportunities we talked about.
The goal being to show clear direction and track progress.
Exactly. It points back to the general requirements for target setting in ESRS 2. But a really significant piece here under S3 is the requirement to explain how the targets were set.
How they were set, meaning?
Specifically, they need to disclose if and how they engaged directly with affected communities or their credible representatives when setting the targets. Did they also involve them in tracking performance against those targets and figuring out lessons learned?
So the standard is actually suggesting that the people most affected might ideally have a say in defining what success looks like and addressing the impacts on them.
It strongly encourages that transparency about the process, yes. It promotes the idea of co-creation or at least consultation in target setting. Companies also need to provide details like the specific intended outcomes for communities, whether targets are stable over time for comparison, and what standards or commitments they're based on.
Can targets for risks be different from impact targets?
They might be the same or distinct. For example, a target to restore livelihoods after a resettlement project that addresses both a positive impact goal and mitigates risks like protests or lawsuits.
And time frame.
Yes, they should distinguish between short, medium, and long-term targets. The standard gives an example like aiming for 100% local employment by 2025, maybe with interim yearly percentage goals. And if targets change, they need to explain why maybe the business model shifted or regulations changed.
Whew, that was a really thorough walkthrough of ESRS S3. If we had to boil it down, what's the absolute core message here?
I think the core idea really is this major push for companies to be way more transparent about their real-world tangible effects, good and bad, on the communities they touch. And that's everywhere, from their doorstep right down the longest supply chain.
Right. And the key things they need to show are identifying who's affected, paying special attention to vulnerable groups and indigenous peoples,
And proving they have the policies, the genuine engagement processes where community input actually matters, and working channels for concerns and remedy.
plus showing the concrete actions they're taking, clearly linking it all back to their core strategy, and importantly, showing that vital link between environmental actions and community well-being.
And finally, setting real, measurable targets to track progress, ideally involving communities in that process. It's quite a shift.
Yeah, it really feels like this moves beyond just, corporate social responsibility fluff. It's a framework demanding accountability for how business operations affect actual people's homes, jobs, rights, health, their lives. It forces companies to look squarely at the human side of their balance sheet, so to speak.
It definitely puts a much brighter spotlight on those connections, which were maybe easier to ignore before.
So here's a final thought then. As more companies start reporting under detailed standards like this, and all this information about community impacts becomes, public knowledge, how might that actually change things? How might that transparency influence your choices, maybe about which companies you buy from or invest in or even work for?
That's a great question.
And maybe even more importantly, what power does this kind of detailed public information give back to the communities themselves, the ones actually experiencing these impacts? What can they do with this information to better advocate for their own rights and well-being?
Think about something you use today. Maybe a streaming service, a smart device.
Or even just the packaging your groceries came in.
Right. Ever wonder how the company behind it considers your well-being?
Your privacy when you clicked agree.
Exactly. or your safety when you use the physical product, your access to, accurate information about what you're buying.
Well, it turns out there's a powerful new framework trying to make companies truly transparent about exactly that.
Welcome to the deep dive.
Today, we're taking a deep dive into a crucial piece of the new European Sustainability Reporting Standards, or ESRS,
Yep. Specifically, we're focused entirely on ESRS S4.
which is all about consumers and end users.
We've been digging into the detailed document outlining this standard
And our mission today is really to cut through some of the technical language.
and unpack what it really means for companies and, maybe more importantly, for you.
Yeah, because this isn't just another piece of corporate regulation, is it?
Not at all. At its heart, this standard is about how companies are being pushed to think openly. Yeah.
And transparently.
About their real-world impacts on the people who buy and use their stuff. So basically, all of us.
Let's get into it.
Okay, so what's the core objective here? ESRS S4.
Well, the main goal is to give anyone reading a company's sustainability report a clear picture
A picture of what exactly?
of the company's significant impacts on consumers and end users.
Right, and that covers everything. Operations, value chain.
Everything. Operations, their entire value chain, the products or services themselves, and even their business relationships.
Wow.
And what's fascinating here, I think, is how broad the standard's definition of impact is.
It's not just about physical product safety then.
No, although that's definitely included.
Yeah.
But it explicitly extends to information-related impacts.
Okay, like what?
Think data privacy, freedom of expression on online platforms, maybe.
And making sure consumers get, quality, accurate information.
Exactly. It also covers personal safety in a wider sense, health, security, even protection of children.
And social inclusion, too.
Yep. Crucial social inclusion aspects like non-discrimination, access to products, and responsible marketing.
Okay, let's unpack this a bit. So it's looking at everything from how your data is handled when you sign up for an app,
Right.
to how safe that physical gadget is,
Definitely.
to making sure marketing isn't unfairly targeting vulnerable people.
Precisely. And the standard also requires companies to disclose any significant risks or opportunities for their own business that come from these impacts.
And the potential financial effects, too.
Yes, what those might be.
Gotcha. And just to be clear on scope, what's not included?
Well, the standard specifically says it doesn't cover situations where consumers themselves unlawfully use or misuse products or services.
Okay, so the focus is squarely on the company's responsibility.
Exactly.
Now, here's where it gets really interesting, I think. This standard doesn't just stand alone, right?
No, it links directly back to the general ESRS requirements, ESRS 2.
Especially those about a company's overall strategy and materiality, how they figure out what's important to report.
Precisely. Companies have to disclose how they consider the interests, views, and rights of consumers.
And consumers are specifically called out.
As a key stakeholder group, yes. They need to show how that consideration shapes their strategy and business model.
So how the impacts they have on consumers connect to their core business.
Yes, and how their strategy might need to adapt because of those impacts.
So this could involve looking at risks in, say, their online platforms.
Or the speed of their product development, maybe even how sales incentives might accidentally lead to bad outcomes for consumers. The source material gives examples like that.
Right. So they can't just put up a policy on a website and say, job done.
No, absolutely not. They have to show how your perspective as a consumer actually influences what they do.
At the highest strategic level.
Yes, and this applies really broadly.
It's not just direct customers again.
No, impacts on consumers through any part of their value chain or business relationships.
Okay. And does the standard get specific about which consumers or impacts?
Oh yes, quite specific. Disclosure Requirement 10 lays it out. Companies must describe impacts on, for example, users of products that might be inherently harmful.
Like tobacco or maybe certain foods?
Could be. Or things that increase chronic disease risk. Also, users of services impacting fundamental rights, privacy, data protection, expression, non-discrimination.
So social media platforms, data brokers.
Potentially, yes. It also highlights those who rely heavily on accurate info, like from manuals or labels.
And there's a focus on vulnerable individuals.
A big focus. Think children, people in financially precarious situations, or those susceptible to discrimination. The guidance mentions gender discrimination as an example.
This raises a really important question then. Are companies truly identifying who might be most at risk from what they do?
Well, the standard pushes them to. They need to explain how they understand that certain characteristics, or maybe how a product is used, might put specific consumers in a more vulnerable position.
They have to look specifically at groups like children, maybe, people with limited financial literacy.
Exactly. Those who might be more susceptible to certain marketing or data practices.
And these impacts, they're not just external issues for the company, are they?
No way. They create significant risks and opportunities for the business itself.
Like reputation.
Sales, absolutely. Reputation, sales, customer base. If products are unsafe or privacy is breached, that can mean huge legal costs, damaged reputation, lost customers. The guidance even gives an example of sales incentives leading to harm and then legal trouble.
But on the flip side,
On the flip side, companies that genuinely prioritize consumer well-being build that trust.
they could stand out.
Huge potential for market differentiation, building a really loyal customer base.
Okay, so companies need to understand these impacts, connect them to strategy. But how do they actually manage them day to day? The standard gets practical here, right?
It does. Disclosure requirements S41 through S44 cover this. First up, policies.
Right, S41, what kind of policies?
Companies have to describe their policies for managing these consumer impacts, risks, and opportunities.
And these policies need to cover the whole process.
Yes. Identification, assessment, management, and remediation, fixing things when they go wrong.
So they need policies, sure, but the standard wants to know if these policies are just words or if they're actually linked to something bigger.
Exactly. It highlights alignment with international human rights instruments.
Like the UN Guiding Principles, OECD guidelines.
Yes, those kinds of benchmarks. They need to disclose relevant human rights commitments, respecting rights, engaging stakeholders, providing remedy.
And it mentions policies about information, too.
Yeah, policies for safeguarding the veracity and usefulness of information provided to consumers. Think labels, ads, instructions.
And crucially, how are these policies communicated?
Good question. They should explain how they communicate them to their own employees, contractors, suppliers.
And directly to consumers.
And directly to consumers, yes. That's in the application requirements.
Okay, so policies first. What's next? S42.
Engagement processes. How companies actually engage with consumers and their representatives about impacts.
So not just sending out surveys.
No, this is critical. It's about genuine dialogue, not just one-way communication. The aim is to understand if engagement happens as part of their due diligence.
Due diligence meaning like their homework on potential risks.
Sort of, yeah. Their ongoing process to identify and manage human rights risks, and how consumer perspectives actually inform their decisions and actions.
Okay, so who should they be engaging with?
Affected consumers directly, or legitimate representatives, or what the standard calls credible proxies.
Credible proxies like consumer protection bodies, advocacy groups.
Exactly. And they need to detail how the engagement occurred.
What stage, what type, how often?
All of that. The application requirements give examples. And who inside the company is operationally responsible? Is there a dedicated role?
Again, the focus on vulnerable groups.
Yes, there's a specific requirement to gain insight into the perspectives of particularly vulnerable consumers, really trying to understand their specific situation.
It really pushes companies to show they actively listen, especially to those voices that might be harder to hear.
It does. And they even have to disclose if they don't have a general process for engagement.
Right, transparency even about the gaps. Okay, policies, engagement. What about when things go wrong? S43.
Remediation processes and channels. This is huge.
Remediation meaning fixing the harm.
Essentially, yes.
Mm-hmm.
Companies must describe processes for providing or cooperating in remediation where they've caused or contributed to a negative impact.
And the channels part.
That's about the ways you, the consumer, can actually raise concerns, directly or indirectly.
So grievance mechanisms, hotlines, online complaint forms, that kind of stuff.
Exactly. The application requirements list examples, and these can be run by the company itself or available through third parties.
Like government agencies, NGOs, industry bodies.
Correct. AR21 mentions those.
It's one thing to have a hotline, but you also need a clear way for people to speak up and for the company to fix things.
You know, way you actually trust.
Exactly. So
Yeah.
the standard pushes on that.
Yes. Emphasis on tracking issues raised, monitoring the effectiveness of these channels.
How do they know if it's effective?
Well, ideally by involving stakeholders, consumers, and evaluating them. They need to assess if consumers are aware of the channels and trust them.
How would they even measure trust? Surveys, tracking complaints,
AR23 suggests things like surveys or tracking complaint numbers and resolutions, yeah.
and protecting people who speak up.
Crucial. Disclosing policies protecting individuals using these channels from retaliation, confidentiality, privacy, anonymity options. That's an AR22.
Makes sense. And again, if they don't have these channels...
Or don't support them via business relationships, they have to disclose that gap too, under DR27.
Okay, quite thorough. So the final management piece is S44, taking action.
Right. Describe the actions taken to actually address impacts, manage risks, and pursue opportunities.
So summarizing action plans, resources allocated, linking back to the general disclosure requirements.
Yes, linking to ESRS 2 MDRA on action plans. And these actions can be aimed at preventing, mitigating, or remediating negative impacts.
Or achieving positive ones.
Or achieving positive impacts, exactly.
And how do they know if the actions are working?
They need to track and assess the effectiveness of these actions. Again, linking to ESRS 2, this time MDRT on tracking effectiveness.
What kind of methods? Audits? Feedback?
AR31 lists methods like auditing, court proceedings, stakeholder feedback, using insights from the grievance mechanisms we just talked about. AR32 really emphasizes linking the action taken to its effectiveness.
So companies need to explain how they figure out what actions are needed.
Yes, and their approaches. This could involve changes to their own practices.
Like product design, marketing, sales, how they use data.
All of the above, DR34 covers that. Or it might involve wider industry collaboration.
And severe human rights issues.
They need to consider and disclose actions related to those if they're connected to consumers. Yes, that's DR35.
What about impacts further down the chain outside their direct control?
They need to talk about using leverage with business relationships.
Oh, enforcing contracts, training partners.
Things like that, yes. Or collaborative initiatives. AR27 and 28 give examples.
Okay, and you mentioned positive impacts. How do they report on actions for those?
They need to describe the initiatives and the intended outcomes for consumers. AR33 covers this, and AR35 makes a point of distinguishing the activity itself from the actual outcome.
Could you give an example?
Well, AR34 mentions potentially linking these to UN Sustainable Development Goals, like making products less addictive to support SDG 3, good health and well-being.
Interesting. And actions also relate back to the company's own risks and opportunities.
Yes. DR33 requires disclosure on actions managing material risks and pursuing opportunities arising from consumer impacts or dependencies.
What kind of risks and opportunities?
AR37 gives examples. Risks like defective products leading to legal or reputational damage, or an economic crisis impacting business continuity if consumers can't afford products.
And opportunities.
Things like achieving market differentiation with verifiably safe products or building a loyal customer base by respecting LGBTQI+ rights, for instance.
And finally, resources. Which teams are involved?
Yes. DR37 and AR41 ask about resources allocated and which functions are involved in managing all this.
Okay, wow. That's a lot on management. So they identify impacts, link to strategy, manage with policies, engagement, remediation, and take action. But are they actually getting better? That brings us to S45, targets.
Precisely. Measuring progress. Companies must disclose time-bound, outcome-oriented targets related to consumers.
What should these targets measure?
Reducing negative impacts, advancing positive impacts, or managing those material risks and opportunities we discussed.
Targets are so key, aren't they? They show if a company is actually serious about making progress.
They do. And here, there's a really interesting requirement, DR41.
What's that?
Companies need to disclose the process for setting the targets, specifically noting whether and how consumers, their representatives, or those credible proxies, exactly, were involved in setting the targets, tracking performance against them, and identifying lessons learned.
Whoa. So they actually have to tell us if they asked you, the consumer, when they set those goals.
That's the idea. AR42 suggests target details should include intended outcomes in consumers' lives, be stable over time for comparability, and clear on the basis standards.
And short, medium, long term.
AR44 discusses that, yeah. For example, multi-year accessibility goals. This is really where accountability baits, isn't it?
How so?
Well, are the targets ambitious? Are they specific? And crucially, does the process involve the very people they are meant to benefit?
Okay, let's try and pull all this together then. What does ESRS S4 really mean for you listening as a consumer or end user?
Well, fundamentally, it's a comprehensive standard that's demanding, I'd say, unprecedented transparency from companies.
Transparency about how their business truly affects the people using their products and services.
Exactly. It forces them to look across a really wide spectrum of impacts.
From your physical safety and data privacy.
To whether their marketing is fair, or if their products are accessible to everyone, including vulnerable groups.
And it requires them to disclose not just that they care, but the actual nuts and bolts.
The policies they have, how they talk to and learn from consumers, how they provide ways for problems to be fixed,
The specific actions they're taking to improve things.
and how they're measuring their progress with clear targets, hopefully focused on real outcomes.
So the standard aims to give you, or maybe consumer advocacy groups acting for you, much more detailed, structured, and comparable information.
Yes, about these really crucial aspects of a company's operations and its whole value chain. It's a framework designed to bring that company-consumer relationship right into the heart of sustainability reporting.
Going way beyond just basic customer service
Right.
issues.
Or beyond.
You could almost think of it like a new kind of report card for companies,
That's a good way to put it.
but one that grades them not just on profits, but on how they treat the people using their stuff. It's putting your experience, your safety, your privacy, your well-being.
Front and center in how companies report on their performance.
So just to quickly recap, ESRS S4 mandates detailed disclosures from companies about their impact on consumers and end users.
Across diverse dimensions: privacy, safety, social inclusion.
It critically links these impacts back to company strategy.
Requires detailed reporting on management processes, policies, engagement, remediation, actions.
And insists on measurable, ideally outcome-oriented targets.
And if we connect this to the bigger picture, this standard really represents a significant step.
How so?
It's embedding consumer well-being and rights into the core sustainability reporting landscape for companies covered by this. The potential is definitely there.
To empower consumers, stakeholders.
To empower them with much more meaningful, comparable, and maybe even actionable information about the products and services they use every day.
Okay, so let's leave our listeners with a thought based on all this.
As companies begin to disclose more under S4, more about their processes for handling your concerns, their specific actions to address impacts on vulnerable groups, their concrete targets for improving product safety or inclusion. What new questions might you start asking about the products and services you rely on every day?
Welcome to the Deep Dive. Today, we are tackling a complex, but I think an absolutely essential topic. We're going into the weeds on the big structural changes coming out of Brussels that are set to redefine corporate sustainability reporting in Europe. Specifically, we're looking at the European Financial Reporting Advisory Groups, or EFRGs, draft amendments from July 2025. These are focused on the two foundational standards, ESRS 1 on general requirements and ESRS 2 on general disclosures. So our goal here isn't just to list the changes, it's to give you the strategic clarity you need to actually implement them. We want to unpack what's mandatory now, how filters like double materiality are being fine-tuned, and what the new rules on value chain data really mean.
It's a critical moment. It really is. These amendments are basically EFRAG trying to streamline what was, a massive and very complex regulation. But the core objective, that hasn't changed. It's still all about a fair presentation of a company's material impacts, risks, and opportunities, the IROs. And that idea of fair presentation, it all hinges on one principle: double materiality. We're looking at things through two lenses. How do ESG factors create financial risks for the company, and how does the company's work impact the world? If you don't get how EFRAG is clarifying that double filter, everything else is just, well, it's a guessing game.
Okay, let's start right there, with the nuts and bolts of the standard itself. A big promise from EFRAG was simplification. So how exactly have they made it clearer what's mandatory versus what's just, guidance?
Well, they've adopted a much clearer structure. It's pretty straightforward, actually. Anything that's strictly mandatory, so any sentence with the words shall disclose or shall report, all of that has been pulled into the main body of the standard, period. And this is crucial because every single one of those shall statements is now a mandatory data point, something auditors will be looking for.
Right, so that immediately cleans up the old confusion between should and must. If it says shall, it's in the core text. So where did all the how-to guidance end up? The methodological parts.
That's been streamlined into these boxed sections they're calling application requirements, or ARs. And in those boxes, you'll see phrases like shall consider, which is a mandatory methodological step, or may present, which gives companies flexibility on, how they format things.
I see. So the main text is the what and the AR box is the how. But what about all the other material that was kind of illustrative or maybe a bit redundant?
That's been moved out entirely. A lot of the deleted data points have been redrafted and put into a new document called the Non-Mandatory Illustrative Guidance, or NMI. And here's the key thing. EFRAG's recommendation is that the NMI should not be part of the final delegated act. For you as a practitioner, that separation provides absolute legal clarity. You're only audited on the main text and the ARs.
That's a huge clarification for auditability. I also noticed they tried to clean up some of the language, the terminology. Did they manage to get rid of some of the jargon?
They definitely did. For one, the term subtopics is gone, which made everything feel so nested and confusing. And maybe more importantly, the word matter, which was it was a vague term, that's been completely eliminated. Now it's just topic or subtopic. It's just a much cleaner, flatter structure.
All right, let's pivot from structure to substance and talk about that core filter. Double materiality. Let's start with impact materiality, the so-called outside-in view of how a company affects the world. How do you determine if a negative impact is material?
So the rule is that for actual negative impacts, materiality is based on severity. And severity itself isn't just one thing. It's a combination of three factors laid out in the ARs. First is the scale of the impact, how big is it? Second, the scope, how widespread? And third, its irremediable character. Can it be fixed, or is the damage permanent?
That focus on irremediable is, well, it's a very powerful metric. But there's a point in here that really stands out for human rights reporting about severity versus likelihood.
Yes, this is a defining principle. For any potential negative human rights impacts, ESRS 1 is very clear. The severity of the impact takes precedence over its likelihood. So even if the probability is low, if the potential impact is catastrophic, say a dam failing and displacing a whole community, the severity has to outweigh that low probability. You have to give it overriding weight.
That completely changes the risk calculus, doesn't it? It pushes companies away from a purely financial model towards something more human-centric. Can you give an example of how far that responsibility extends?
Absolutely. The standards are clear that this doesn't start at your own front door. Take the cobalt example. If you make a product using cobalt that was mined with child labor, many tiers up your supply chain, that negative impact is still considered connected to your company. Or take finance. If your company provides a loan to another business, and that business causes major environmental contamination, well, that contamination is connected to you because your money enabled it. It's about full footprint accountability.
And before we move to the financial side, there's a rule about not trying to balance the books, so to speak.
Precisely. To stop greenwashing, the standard says positive impacts have to be assessed on their own. They shall not be netted off against negative impacts. You can't use a small community project to try and hide a massive environmental incident.
Okay, let's look through the other lens, financial materiality, the inside-out view. What are the main drivers of financial risks and opportunities here?
Well, it can stem from the impacts we just talked about, but there are two other key sources. First, a company's dependencies on resources, natural, human, or social. If those become scarce or more expensive, that's a financial risk. And second, it can come from other external factors like climate hazards or new regulations. And what's really critical here, practically speaking, is the timeline. AR-15 says you have to look at financial effects over the short, medium, and long term. The goal is to flag financial effects that are coming down the pike but aren't on your balance sheet yet. Things you know you'll have to pay for but don't yet qualify as a liability.
That really makes the sustainability statement a forward-looking partner to the financials, rather than just a look back. Now, let's get to what is probably the biggest operational challenge for most companies, the value chain. Where does that reporting boundary actually stop?
The basic rule is that reporting shall cover the whole value chain, both upstream and downstream. But, and this is a big but, it's tempered by a practicality clause. You only have to report what's based on reasonable and supportable information available without undue cost or effort.
That phrase, undue cost or effort. I mean, that sounds like the biggest potential loophole in the entire standard. Who gets to define what undue is? Is there any guidance on that?
That's the central question, and it comes down to professional judgment. EFRAG deliberately avoided putting a number on it because what's undue for a small company is very different for a multinational. But you can't just claim it's too expensive. It has to be genuinely disproportionate, and if you use that clause, believe me, your auditor is going to challenge you on it. You have to be able to defend that judgment call.
So not a free pass, but something you need to document robustly. Okay, so given how hard this can be, especially with SMEs in the supply chain, is there any other relief available?
Yes. For certain complex metrics like Scope 3 greenhouse gas emissions, there is. The standards say you may use estimates and proxies instead of getting direct primary data from every single actor in your value chain. This is especially true if you're dealing with SMEs who just don't have the systems for that kind of reporting.
Okay, that's helpful. But let's talk about the big strategic takeaway here, the timeline. How long do companies actually have before they have to fully comply with all of this value chain data collection?
This is probably the most important piece of transitional relief in the whole thing. For the first 3 years of reporting, if you can't get the value chain data you need, you only have to do 3 things. Explain the effort you made, explain why it was unavailable, and critically, explain your plan to get it in the future.
Wow. Okay. 3 years of a phase-in. That is a game changer. So what happens after that? In year 4?
In the 4th year, full inclusion of all material value chain information becomes mandatory. So this 3-year window is really a strategic gift. It lets companies build their systems, engage with suppliers, and get ready without being penalized right out of the gate.
That timeline is absolutely critical for anyone doing budgeting and project planning right now. All right, let's shift our attention to the mandatory disclosures under ESRS 2. These apply to everyone, regardless of their materiality assessment. Let's start with GOV1 on leadership accountability. What do boards need to disclose?
GOV1 gets really detailed on the role of the board, or the AMSBs as they call them. It's not just about the percentage of independent directors. The really challenging part is the requirement to disclose how the board ensures it has the skills and expertise to actually oversee material sustainability issues. It's an explicit call for board-level competence on ESG.
That puts huge pressure on board recruitment and training, doesn't it? It's not enough to be compliant anymore. You have to be literate on these topics. And what about linking performance to pay?
That's GOV2 on incentive schemes. If you have remuneration policies tied to sustainability, you have to disclose the details. What metrics are you using? Emissions targets, diversity goals, and what proportion of variable pay depends on hitting those targets. It's all about transparency and alignment.
And finally, under SBM1, the business model section, I saw they identified some very specific, sensitive sectors that require mandatory disclosure no matter what. Which ones are on that list?
They singled out 4 areas. Any involvement in the fossil fuel sector, so that's coal, oil, and gas chemicals production, the controversial weapons industry, and the cultivation and production of tobacco. Even if it's a tiny part of your business, if you're involved, you have to disclose it. And we have to mention connectivity. ESRS 1 now requires that the data and assumptions you use in your sustainability statement must be consistent with what's being used in your financial statements. The two have to talk to each other.
So if your sustainability report says a climate risk will shorten assets' useful life, that same assumption has to be reflected in your depreciation calculations in the financial statements. Is that right?
Precisely. That is the ultimate test. And if your data is spread across different reports, you can use incorporation by reference. But there's a big trap there. Anything you incorporate by reference has to be subject to the same level of assurance as the sustainability statement itself. You can't just point to some unaudited document to tick a box.
This whole deep dive really shows a shift from, voluntary frameworks to something much more rigorous and legally binding. We've seen structural simplification for clarity, a really high bar on human rights, and this phased-in approach for the value chain.
And as you move forward with all this, I want to leave you with one final kind of provocative thought. Buried in ESRS 1, there's a sort of escape hatch. It says an undertaking is not required to disclose classified or commercially sensitive information, even if it's material. The only catch is you have to state that you're using the exemption. This creates a really fascinating strategic dilemma. The EU is pushing for transparency, but it also recognizes that forcing a company to disclose, say, a trade secret or a critical supply chain vulnerability could harm them. So the question I'd leave you with is this. How will the market and your stakeholders react when you say, this is material, but we're not telling you what it is? How do you balance that pressure for transparency against the need for strategic silence? That's where the hardest calls are going to be made.
A critical line in the sand indeed. Thank you for joining us in this deep dive into the future of corporate reporting. We'll see you next time.